Today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point.
Nowhere near as bad as the market feared.
But they really want to tell us that the base case is a hold for January.
The first takeaway is the pause is in.
I think you could see some more rate cuts in the back part of next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks failing to keep momentum from yesterday's Fed rate cut, with futures lower as traders revive artificial intelligence-related fears. Broadcom results on deck after Oracle's report spooked investors, with the company raising its spending plans beyond what was expected. Now, jobless claims very much in focus, with Fed Chair Jay Powell sounding a cautious note about the U.S. labor market. We get those initial jobless claims at 8:30 a.m. Eastern. I am so pleased to say that David Gura is going to be alongside me for the next 3 hours. David, what a wild 24 hours it's been, with whipsawing price action and sentiment.
Absolutely. I mean, on the heels of that Fed meeting, we saw markets respond so positively. Then we had those Oracle numbers, went the opposite direction. I guess kind of encapsulates the ups and downs that we've seen over the course of this year.
Yeah, and the push-pull right now of, is it the Fed or is it AI, right? Is it a question of monetary easing, or is it a question of how much some of the hopes and dreams of technological prowess can really fulfill the GDP numbers and all of the optimism that we've seen in the U.S. economy?
And that debate really manifests in what we heard from the Fed chairman yesterday as he talked about those economic projections, which were, I think, much rosier than a lot of people expected, indicating perhaps a belief on the part of these policymakers that AI renaissance, AI's future is going to have a huge effect here in the U.S. economy going forward into 2026.
And it's clear that this is a Fed very concerned, also expecting the productivity gains from AI that could potentially fuel this kind of Goldilocks scenario that's really supporting markets. What we are seeing in markets right now is a little bit of a dip in futures ahead of the open after yesterday seeing the best post-Fed performance on the S&P going back to March. Today, we're taking that back, down 0.6% on S&P futures. NASDAQ down even more in pre-market trading. Dollar softening, really picking steam. We've crossed through that 117 level on the euro-dollar cross. And yields had been up to 4.20 on the 10-year. Now they are down to below 4.14, just to give you a sense of how much we've retraced what that bond sell-off had looked like. Coming up this hour, we've got Dan Skelly of Morgan Stanley Wealth Management, with stocks coming off their best Fed day since March, as we were just saying. Stefan Slowinski of BNP Paribas, as Oracle shares fall by double digits. And Claudia Sahm of New Century Advisors, and why Fed Chair Powell may have cut rates for the last time. We begin this hour with stocks lower as AI spending concerns weigh on markets. Dan Skelly of Morgan Stanley Wealth Management writing, we are more bullish on corporate earnings and margin expansion due to CapEx, AI, and deregulation versus Fed cuts. In fact, we probably lean more hawkish than the market. Dan joins us now. You're going to be joining us for the hour. Thank you so much for being with us.
Great to see you, Lisa.
So, Dan, you're taking the exact opposite approach right now from the market, that you actually think that AI is the promise and Fed rate cuts are kind of the spoof. So can you explain why you are completely counter to what the market is kind of expressing right now?
Sure. And look, we had a bit of a drawdown in the last month or so. We had a 5% drawdown, and it was noisy. It was around a lot of positioning, rebalancing, technicalities. And look, the signal continues to be really strong. Earnings strength is broadening out across other sectors. What are we seeing today with the AI narrative? We're questioning the funding of AI. We're questioning the timing of AI. What we're not questioning is the validity of AI. We still don't know truly what the productivity gains are going to look like. And frankly, that story and that uncertainty is going to continue with us for some time to come. And frankly, I think that's the opposite of what a bubble looks like. If everyone was euphoric about AI, I'd be more concerned.
We'll get into bubble talk in just a second. Let's start with
Inevitable.
Fed. It is inevitable. It's sort of this question of what is a bubble? Are there different kinds of bubbles? How big is the bubble? The different bubbles of time that are I mean, really, the amount of bubble talk that I've seen over the past 24 hours has knocked your socks off. I'm just wondering from your perspective from the Fed side,
sure,
how much the Fed is looking at AI productivity gains as a reason to cut rates, right? Is the Fed leveraged to AI just as much as the rest of the market?
Well, I think the labor market weakening is not really coming from economic weakening. It's coming from a shift in intentional immigration policy. It may be, yes, coming from the entry-level automation of some work because of AI, which is positive for earnings, to your point. So I think the Fed is basically acknowledging for the first time more vocally per Powell's comments that productivity is coming, and so they want to be more concerned if the labor market takes a bigger dip. But we think, frankly, when you look out next year, there's a positive story story, but the story is going to look differently in terms of leadership than it has in recent years.
Let me marry this with the dual mandate and talk a bit about inflation. So marry AI with the inflation narrative. And you look at what happened with Oracle. We see this kind of moving in a direction now where a lot of these bets are heavily levered. They're taking on a lot of debt to build these data centers. What does that tell you about the calculus the Fed is going through right now, thinking about how inflationary they might be going forward?
Well, I think one of the most interesting takeaways from yesterday, David, is there is less and less consensus within the Fed. I think looking out at the dot plot over the last couple of months, everyone had predicted cuts, and now you're looking at 3 potential hikes from the dot plot. So, when we think about the Fed's calculus, they're going to continue to focus on all the things they look at. But at the end of the day, and back to Lisa's earlier point, we would just highlight again, there's a paradigm shift going on in the economy where more and more spending and more control or attribution of the economy is coming from rate inelastic sources, be it services and high-end consumers, and there's a lot of kind of intersection there, and AI spending, which is coming mostly from companies who can spend whatever they want. And so the rate picture, we think, doesn't figure as much in maybe to the fundamental picture as much.
Let's talk a bit about uncertainty. So the Fed chair used the usual boilerplate as he presented these dot plot forecasts. They don't represent the opinion of the committee. They could change, et cetera, et cetera. There is so much uncertainty just on a policy variant. There's so much uncertainty about personnel as well.
Sure.
Is there, when you look at those dots, do you have less credence in them than you would otherwise? Or what do they tell us? They tell us even less than usual.
I think they tell us less than usual. I think that the changing nature of the debate within the Fed itself is telling us there's going to be uncertainty. And I think, look, you mentioned the other comment in terms of other policy issues, Fed independence. The dollar has been in a pretty stable place for the last 4 or 5 months after having a really weak first half. So should Fed independence come back into the 4 early next year, we think the dollar could resume its decline that it had earlier this year.
Just to build on what David was talking about, though, the whole idea of quiet dissents really took off over the past 24 hours. The idea that in that dot plot, there were a number of members, I believe 4, that came out, or 6 actually, that came out and said that they think that rates should have stayed where they were before the rate cut, indicating that should they have been on the voting committee, they would have voted not to necessarily cut rates. Does that indicate that Powell is losing some clout, and whoever is going to be the head of the next Fed isn't going to have the same kind of thumb on the scale as Jay Powell had as leader, and frankly, as all Fed chairs have had, going back to, say, Paul Volcker?
Yeah, it's a really interesting point. I hadn't thought of it. He may be. And everyone may know that, of course, his time is coming to a conclusion. And so
you don't say.
So there may be some rising dissent there. But look, coming back to our earlier thread, I think if productivity, and particularly in a once-in-a-generation tech cycle, is driving a new narrative, and frankly, the high-end consumer and services story is more disconnected from the rate cycle than we had ever seen before, it may not matter as much. And that's what we're really trying to reiterate to our clients.
Does that indicate the big tech has to be the leadership going forward, and not necessarily this broadening out this rotation, particularly into small caps, that we saw took off yesterday after the Fed meeting?
Yeah, my colleague Mike Wilson just upgraded small caps, and in the 1 month mark to market, he's had a really good call so far. And look, we would say that momentum could continue into the first half of this year. But I'm just, again, not as inclined to think for the balance of the year that trend continues. What we really see, Lisa, is the leadership shift going from an equity perspective from Mag 7 the last 2 years to Fortune 100. And it's not necessarily going to be mid or small cap. It's going to be quality large companies who are adopting AI and now have more earnings upside and more earnings productivity. And keep in mind, that was not the narrative the last couple of years. But it is shifting this year. I think people would be maybe surprised to note that Mag 7 hasn't been the monolith that it had been the last couple of years.
What gives you confidence, you and Mike, confidence in the kind of catalytic nature of this moment? Because I think the dialogue over the course of 2025 has been, look, Mag 7's too consolidated, the market's too consolidated, it has to broaden out. And we really haven't seen that over the course of this year. Why now? What gives you that confidence?
So the broadening is still happening gradually. So I think money center banks, as a case in point, has been a strong leadership group this year. Finally, healthcare is catching up, and there's some big market cap contribution there vis-a-vis big pharma, which is starting to work, medical devices, and other parts of the kind of growth healthcare sphere. But we would just say, again, I think people mistakenly make this case that it's Mag 7 to 493. And we'd argue the 493 is not necessarily the highest quality cohort. So given all these uncertainties we've talked about already this morning in terms of Fed policy, economy, inflation, we still want to lean towards quality, but we're seeing that more in the Fortune 100.
Let me ask you lastly, as we stick with the Fed here, sort of your sense of the importance it's going to play here going into 2026. So Lisa, you bring up as well that Jay Powell's tenure is coming to an end here, at least as chairman. We'll see what happens with his governor position. Does it take a less outsized role here in 2026?
I think the Fed has shifted so much to being on the front foot in terms of communication that I don't see anything really changing to that in terms of reactions from the market. And keep in mind again that we've seen over the last 7 or 8 months a 3% drawdown followed by a 5% drawdown. What it indicates is that I think investors are moving towards a more benign view of the world, and there's so much cash and liquidity still on the sidelines that all of these short-term corrections will be bought up.
On the front foot, including Anna Paulson, who's speaking later this morning, as well as Austin Goolsbee. Watch that space, and Beth Hammack all today. So on the front foot in terms of communication, plenty of Fed speak still coming down the pike later today to restart after that quiet period. Dan Skelly, we're not letting you go. Stick with us of Morgan Stanley Wealth Management as we parse through the stories. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand.
Good morning, Lisa. President Trump confirmed that U.S. forces intercepted and seized a sanctioned oil tanker off the coast of Venezuela, marking a serious escalation of tensions between the two countries. The Trump administration has ramped up pressure on Venezuelan President Nicolás Maduro, accusing him of presiding over a drug trafficking operation. Meanwhile, President Trump continuing to criticize Fed Chair Jay Powell after yesterday's rate decision, the president saying the 25 basis point cut could have at least been doubled. The president's comments coming as he interviews candidates to replace Powell. Trump saying he is looking for somebody that will be honest with interest rates and that his view is that the rate should be much lower. And Oracle shares are dropping nearly 11% in the pre-market. The software maker reporting a jump in spending on AI data centers and other equipment, but investors are concerned those investments are taking longer to translate into cloud revenue as cloud sales in the fiscal second quarter fell just short of analyst estimates. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. David, doesn't it feel like at this point Oracle is just a proxy for OpenAI and Sam Altman, and essentially he's just pulling the strings, and if he's not doing great, then Oracle's not going to do great either?
Eager to talk about this more over the course of these next few hours, but yes, it does feel like it is a proxy in that way and sort of highlights the kind of circular story that we've been talking about during recent months.
Ongoing circular financing. The other circular discussion is geopolitically, and what is the next hotspot? Up next, escalations with Venezuela.
We've just seized a tanker on the coast of Venezuela, large tanker, very large. Largest one ever seized, actually.
Bloomberg's Tyler Kendall joins us next from New York. This is Bloomberg Surveillance. Taking the froth a little bit off of some of yesterday's Fed-induced rally, it was a pop, getting us close to 0.1% within of the all-time high on the S&P 500. Now, we're taking some heat out of that. Why? Because of Oracle. Why did you do that, Oracle? Down 0.5% on S&P futures. The NASDAQ really being dragged down by that move, down 0.7%. The Russell 2000 doing better. This is expected because when you take a look at 2s, 10s, and 30s, you could see why futures are a little changed on that small cap index. You could see yields significantly lower than where we began yesterday with, particularly on the front end of the yield curve. We saw almost 8 basis points of a decline yesterday alone. We build on that 3.54% on the 2-year, a more muted kind of a gain on the longer end. And this really goes to that yield curve steepening that we've seen with the 30-year still in and around 4.8%. Meanwhile, a real focus on geopolitics with discussions about a possible conflict brewing in the Americas. Under surveillance this morning, escalations with Venezuela.
We've just seized a tanker on the coast of Venezuela, large tanker, very large. Largest one ever seized, actually. And other things are happening. It was seized for a very good reason. We keep it, I guess. I assume we're going to keep the oil.
Here's the latest. U.S. forces seizing a sanctioned oil tanker off the coast of Venezuela, further escalating tensions between the two countries as the U.S. ramps up military presence in the Caribbean. Bloomberg's Tyler Kendall joins us now. Tyler, this does seem like a pretty substantial escalation. What do we know about the circumstances behind this seizure and what could potentially follow?
Yeah. Hey, Lisa. Good morning. You're exactly right. This is a significant escalation of tensions between the two countries as the U.S.'s pressure campaign has now taken aim directly at the heart of Venezuela's oil-based economy. Now, our reporting indicates that this tanker has for years been known to be considered part of what's called the dark fleet that supports Venezuelan and also Iranian oil exports and was well known to authorities. This exact tanker had the capacity to transport nearly 2 million barrels of oil, and other shippers may now be reluctant to load cargo, which means that this really could have an impact on Venezuela's oil export market. Just for some context here, data shows us that Venezuela exported on average 750,000 barrels of oils per day last year, with more than half going to China. As analysts point out, that U.S. restrictions on U.S. companies operating in the country has actually been a boon to the Chinese market, which has been buying these barrels at a discount. Now, as you mentioned, this is part of this broader backdrop that the U.S. has had its largest military buildup in the Caribbean in decades as they go after alleged drug traffickers, conducting at this point nearly 20 strikes in the Caribbean. But Lisa, I'll point out that our analysts at Bloomberg Economics say that while the administration has really justified its actions as going after drug traffickers, this really serves that broader purpose to turn the screws on Nicolas Maduro in Venezuela. President Trump earlier this week in an interview with Politico did say that Maduro's days are numbered, in his words, though declined to say how far he would go to get him out of power. But we do know, as of now, the option of land strikes inside the country still remain on the table.
Tyler Kendall of Bloomberg, thank you so much for that. And David, I'm looking right now, oil prices down. Right? I mean, you see here all of this and potential disruptions to oil supply, concerns about geopolitics. The move is anything but concerned when you take a look at what's going on in markets.
Yeah, fascinating to think about this in light of the conversation with Mike Wirth of Chevron earlier this week. That company's still doing business in Venezuela and just the ambiguity surrounding all of this. So Tyler rightly bringing up at the end there, the prospect of there being land strikes still looms large as we've seen the kind of all of this military might brought to this part of the world, everyone wondering what's going to happen next. It's fascinating to see. Of course, this is part of the shadow fleet that's been so front and center in the context of the Ukraine war. And then we've got the leader of the opposition group in Venezuela, Maria Corina Machado, making her way to Oslo under cover of darkness, not to accept the award, but to be there for that Nobel Peace Prize this week, raising a lot of questions about what happens with the opposition going forward here? What role are they going to play? What's it going to be like? How is she going to get back to Venezuela on the heels of that?
Yeah, well, and Dan, this just goes to the idea that the glut of production overwhelms any kind of geopolitical disruption when it comes to markets, even if the headlines seem pretty significant.
And we'll see if that continues, right? OPEC Plus had just signaled within the last couple of weeks that they actually might now be at a place of equilibrium, and they may not be contributing as much supply. So I think when you look at zooming out the political landscape, we're obviously on the path, fortunately, to de-escalation in the Middle East. Let's also go back to Ukraine, however. It does not seem like it's going the same direction. So we go back to this idea around inflation has been relatively muted, but we'll see if commodities continue to behave that way next year.
Yeah, and this sort of geopolitical overlay, on one hand, the oil story is one side of this supply-demand dynamic. On the other side, there is the ongoing question between the U.S. and China. And when it comes to artificial intelligence, NVIDIA yesterday refuting reports that its top-of-the-line Blackwell chips were smuggled into China. This coming just days after President Trump gave the green light for the company to sell its less advanced H200 chips in the country. Anna Ashton of Ashton Analytics joins us now. Anna, great to have your insights on this. What did you make of the back and forth, the accusations about DeepSeek, the response that they couldn't have possibly used enough chips under the cover to actually be that successful? Where is the reality here?
I mean, I think that the reality is that we just don't know where China is in its advancements, but we do know that the restrictions that have been in place, I mean, what Jensen Huang has argued, there's a lot of weight that should be given to that the restrictions in place have only sped China's efforts to catch up with the United States in terms of advanced chip technology. And that technology is definitely getting better.
There's a funny thing at play here, Anna, and that is there is a clear need on China's part to have these types of chips. And yet what's ambiguous or we don't know is what the demand is. And I go back to the last time NVIDIA reported earnings. We heard from Jensen Huang, and he said they're kind of using as their base case here that China's not buying any of this. So we have this development over the course of the last week. The U.S. is going to allow the export of these chips, yet the demand part of this still is unknown. And I wonder sort of what you make of that and sort of how you're seeing the interest on China's part in these chips going forward.
Well, what's interesting is that when Trump announced that the previous deal that never actually came to fruition, that would have allowed more chips from NVIDIA to go to China, not H200 chips, but that deal, China responded to by warning companies not to buy NVIDIA's chips, talking about potential backdoors, et cetera. So there's clearly pressure from the Chinese government on major Chinese tech companies not to rely on American chips. And that is because the Chinese government wants to incentivize the companies to develop their own technology. At the same time, the recent smuggling accusations, Operation Gatekeeper, those show that, the demand for advanced chips is certainly still there. Everything that we understand is that, the capabilities of something like DeepSeek are of course limited by lack of access to the most advanced chips, and it requires far more chips, less advanced chips, to achieve what it has achieved. So it's hard to imagine that DeepSeek actually did that using less power or less in the way of GPUs than is typically used here in the United States. But at the same time, power is cheap in China. So if China has to use more power in its efforts to fuel the advancements of its tech companies, then it will.
And how do you think about the national security side of this story? So there is, as a backdrop, a lot of happy talk from this administration, from the company as well, about its ability to kind of curtail China's chances of or ability to kind of use these chips to erode U.S. national security. You talk to anybody from the Biden administration, though, and they're raising a flag about how this is a huge misstep on the part of this administration. You can't be kind of leveraging national security in this way. How do you think about it, I guess, from a practical perspective? Is it possible to insulate these chips and U.S. national security from their adoption in the U.S., in China, rather? Walk us through the way you're thinking of that framing.
I mean, I think that, this is a case of people who think that the best offense is a good defense versus people who think that the best offense is a good offense. Certainly, a good defense is helpful. But at the end of the day, it's going to be hard to limit China completely from accessing the United States' most advanced chips. For one thing, they're made on China's side of the world. And so the best offense really is a good offense. That doesn't mean that we shouldn't have measures in place that prevent China from using these chips in ways that would be undermining our national security. It's just that those measures are only going to be so effective. So really what we should be focusing on is ensuring that our own companies are as competitive as possible. One argument there is that sales to China help our companies be as competitive as possible because the revenue that is generated from a market that big allows for more R&D and development. But the counter argument to that is that, China is already limiting those sales. And ultimately, as China does catch up in terms of advancing its own technology, those sales are going to drop off. So,
And Ashton of Ashton Analytics, thank you so much for those insights. I'm just wondering, Dan, from your perspective, how much are you looking at the sort of geopolitics of the U.S. versus China in the chip sector in an investment thesis way?
Yeah, it's a massive underlying theme for us. We've talked about this from Morgan Stanley's research lens, too, in terms of this multipolar shift. And this has been going on in terms of trade and tariffs and reshoring as well. I guess just thinking about Anna's comments, zooming out, to follow on to something David said, ultimately, longer term, who's going to use which partner? If the U.S. and China have two separate models, is China ever going to be relied upon in terms of the security questions around their technology?
Well, we're going to pick up that conversation exactly coming up next with Stefan Slowinski of BNP Paribas, with Oracle concerns front and center, plus Yahira Anand with your morning movers. This is Bloomberg. Yesterday, markets got exactly what they wanted from the Federal Reserve. Not only did you get a 25 basis point rate cut, you also got indications that this Fed was not nearly as hawkish as some people had feared. There was a huge pop in equities. You saw it close out S&P close to the all-time highs. Then Oracle reported, and everything went the other direction. S&P futures lower by about 0.5%. You're seeing dollar weakness continue, 117 on the euro-dollar cross, and yields significantly lower, particularly on the front end. Even on the long end, though, 10-year yields lower by about a basis point to 4.13%. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Oracle's disappointing results are rippling through the AI trade this morning. Oracle said that it plans to spend an extra $15 billion in capex in the fiscal year to fund its AI projects with the likes of OpenAI and others. But the returns just aren't showing up fast enough for investors. And that is why we are seeing other big AI spenders like NVIDIA and Meta getting hit this morning. NVIDIA down nearly 2% now in the pre-market. Meanwhile, we move on to Gemini. This is the company run by the Winklevoss twins. Shares are surging 16% in the pre-market after regulators cleared the firm to launch a derivatives exchange, a move that would allow the company to enter the red-hot prediction market, which, as we know, is currently dominated by Kalshi and Polymarket. And we end on PDD. Shares are falling 2.2% in the pre-market. This is the company behind Temu, and shares are falling on our reporting that fistfights broke out last week between Chinese regulators and employees at its Shanghai factory. While we don't know why the altercations started, we do know that the audit was tied to alleged fraudulent activity, which is stoking fears of increased government oversight over PDD, which has made major gains here in the U.S. with its Temu app. Lisa?
Thank you so much, Yahaira. I'm still stuck on the Gemini space station that I assumed was them taking off, but instead is prediction markets.
Yeah.
Okay, there we go. Space station is not exactly the
know.
International Space Station. On our radar this morning, not that. Oracle shares sinking after the company reported disappointing cloud sales and a massive jump in spending for AI data centers. Investors worrying the high cost of its building out of its infrastructure is taking too long to turn profit. Those shares lower about 11% in pre-market trading. Dan, do you think some of these concerns over the debt-fueled aspect of the AI build-out are overblown, or do you think that it truly is a reason to stay away from certain pockets of the credit market?
I think it's more of the latter, and I think it's entirely healthy, right? When we think about the last 2 years, most of the cloud names were funding AI spend from cash flow. So the market is, we think, appropriate and correct to start questioning some of the extension of leverage. That having been said, the most important catalyst is still yet to come, which is back to what we were discussing earlier. When does the Fortune 100 start to actually announce earnings monetization? And that hasn't really happened yet. So it's really hard to question the entire cycle until you have that particular dynamic.
Which is a reason why I think a lot of people are looking to Broadcom and are looking at, in particular, OpenAI to see whether that part of the cycle really is the sort of weak hand, right? I mean, this is sort of the question with circular financing. Are there weak hands embedded there that could potentially cause systemic risk?
Yeah, circular financing now becoming kind of elliptical, I think, Dan, as I think about sort of the way in which this is playing out. And I'm curious, as you think about this and you look at the investor agitation that we've seen over the last, not 24 hours, but a little less than that, what your sense of timing is. So there's clearly a desire here to see some proof in the pudding. Your sense of what patience you and other investors have to see something manifest when it comes to these investments?
It is a fantastic question, David. And I wrote about this in my last quarterly investor letter. Is there a Wile E. Coyote moment where the market just gives up patience and the bottom just falls from under? And look, we would say, based on our observations, based on earnings transcripts, but also based on a lot of survey work, right? Morgan Stanley does a quarterly CIO, Chief Information Officer survey. And when you look at that trend over the last year or so, projects were being put in place a year ago. And when we listen to companies today, they're saying we're getting closer to actually seeing productivity gains. The most likely phase of the sequence is actually seeing the earnings announcements. So to give you a more specific answer, we think it's in the next 9 to 12 months. Okay.
Wow, which is the reason why I think people are looking for that rotations trade. Also looking for the rotation trade based on the Fed. Fed Chair Jerome Powell warning that the official U.S. jobs numbers could be overstated, potentially by 60,000 jobs monthly. Powell indicating that the U.S. economy could actually be losing jobs, a concern that played a part in the Fed's interest rate cut. More on that coming up a little later this hour. The battle for Warner Brothers Discovery, meanwhile, is ongoing, drawing some political fire, with President Donald Trump weighing in.
I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue.
Those comments creating more questions than answers right now about the deal and its potential realization right now in markets. Let's turn back to Oracle. It really is dominating markets this morning. Surging capex alongside disappointing sales have been sending shares tumbling down 11.5% in pre-market trading. Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, how bad were these results? I mean, was this really an issue of weakness or just an issue of concerns getting fed by some of these spending plans?
I mean, it's more the latter. And look, what's changed in the last 90 days is, the focus on capex efficiency that was really brought by Google. And Google has shown not only have they built infrastructure for these AI models, but they've trained their own models using their own chips, all with, the $90 billion in capex they're spending this year and another 100+ billion next year. And that's the lens that investors are using to measure the capex efficiency of other hyperscalers. And Oracle is just a provider of AI data center infrastructure. It hasn't shown, other products that are benefiting from AI spend. And that's where, the question remains to be asked is, if it's a lower margin business, should investors be, sponsoring Oracle to raise another $200 billion, even though their backlog is close to $500 billion? So the question is around the margins and the quality of the revenue that Oracle will be generating through this spend.
Mandeep Singh of Bloomberg Intelligence, thank you so much. I look forward to catching up with you after Broadcom reports earnings. Stefan Slowinski of BNP Paribas writing, while Oracle did all that was asked, the market was not buying it. Spooked by another $15 billion lift to this year's capex, Stefan has an outperform rating on the stock and a price target of $290. Stefan joins us now for more. Stefan, how much do you see this as a buying opportunity, given the fact that people seem to be really committed to this fear that Oracle is overspending and overly committed to OpenAI?
Yes, good morning, Lisa. Thanks for having me. And as I said this morning, Oracle really gave us everything that we wanted or investors were wanting. Oracle Cloud Infrastructure grew 68%, which was in line with expectations. There were lots of concerns that there had been delays at their Abilene, Texas data center. That turns out not to be the case, and they are on track for the full year. There were lots of concerns on the financing side, and Oracle came out and said, we're committed to investment-grade credit rating. So that's a relief. And they also came out and said that the fundraising expectations that the market has for the next few years are too high, and that they won't require as much capital as is needed. So they kind of addressed all of those topics head on with new management, not ducking any of the tough questions. But the market is still looking at that OpenAI overhang. Despite diversifying with deals with Meta and with NVIDIA, they still have a lot of exposure to OpenAI. So I think the market needs to get comfortable that OpenAI will be viable and continue to be competitive. B, that there's a sustainability of this AI investment and infrastructure need beyond OpenAI. And that C, Oracle can sustain some sort of technical advantage, which the market's not convinced about, in order to maintain its margins in this business.
You mentioned the leadership change. This is a post-Safra Catz Oracle. And I wonder how you're thinking about leadership at this company, the continuity from her to this team of two, what questions you might have about them and the direction of this company. How sort of continuous is it?
Yeah, hi, David. I think that's a great question, because when you look at Microsoft, the stock is struggling right now, and people are even questioning Satya and Amy, the CEO and CFO, who've been there a long time. They've deployed capital very successfully, very in a disciplined manner, and even there, people are questioning the outlook for their spend. I think with Oracle, it is a new management team. Now, the good thing is all of the management team have been with the company a long time. They're known to the market. They're very operationally experienced. And I think, like I said, they did very well in the conference call last night, but they are improving. And so that just adds another variable here to the outlook for Oracle. But to come back to Lisa's question, this is a company that's now trading on 9 times earnings on that 2030 guidance for $21 of EPS. And that is all on already signed and committed business. So we're starting to see a lot of those fears around OpenAI, around AI, around monetization, around execution being reflected in the share price here.
I'm curious how you think of the proxy-like nature of this company. Yes, for OpenAI, I suppose, but for AI more broadly. I guess we'll see if it manifests itself with Broadcom a little later today. But what is this company's performance telling us about the prospects of AI more broadly?
Well, we continue to see a ramping of their backlog. So their RPO was over $530 billion, adding another 60 or 70 billion quarter over quarter. I mentioned the revenues for OCI, hitting the 68% growth rates. So that demand keeps coming in, but the companies are almost getting penalized for that now, which is more CapEx leads to a revenue raise for next year, but the market's looking at it more on the risk side. Obviously, a lot's been talked about with the Oracle CDS and the credit side of things. This is the largest non-financial US dollar debt issuer. They've got about 90 billion of debt outstanding. There were concerns they would slip down into high yield. If that were the case, Oracle's debt load is bigger than 13 of the 18 high yield sectors. So that's the importance that we're seeing here. It's also very different than the other hyperscalers that are all AAA or AA rated. With Oracle, you're BBB rated. So that's another reason why people have been looking at this as a proxy. And obviously, out of the 530 billion of backlog, probably over 300 billion of that is just OpenAI alone.
My question is, thinking about this stock in a much longer historical context, if you look at their traditional software business, it was flat to down in the quarter. And clearly they're making a pivot in terms of their corporate strategy. So almost following on David's comment in terms of management, just when you think about your industry experience and history, are there precedent examples of companies who've made this big a shift in the past before and been successful?
I think if you look at Microsoft, obviously adding cloud to its business over a decade ago with Microsoft Azure, obviously leveraging its expertise and technology capabilities and positioning with the enterprise into cloud and moving into more of an infrastructure business. Of course, there were concerns then about the margin impact, but obviously that's been very successful for them. What Oracle is also trying to do, and again, the market's not convinced of it yet, is that it will be a unique AI provider in the sense it's the only company that has the infrastructure. It has the software infrastructure as well in terms of the database, and it also provides applications. And so what Oracle is also trying to tell the market is most corporate data still sits within the Oracle database. And now with Oracle Cloud Infrastructure, its data center and infrastructure business, you can put that on top of that data in your Oracle databases, use whatever model you want, and build new AI applications on top. So they're saying this is not just going to be a sort of a renting a GPU cluster business. This will be more of a software business over time, leveraging all of those assets that they have. But for now, the market's focused on the spending, as we probably have negative free cash flows here, at least for the next 3 years.
Stefan Slowinski of BNP Paribas, thank you so much for those insights. And Dan, I would turn the question back to you. If there is this expectation that it could be the next Microsoft or Amazon in terms of what we saw in the past and some of the potential, is it better to be invested in the debt or the equity, right? Which is the better proposition when they're depending on the debt markets to really build themselves out? Yeah,
it's a really fabulous question. And I think he referenced 9 times 2030. So if you really believe that $21 out year number, the equity looks pretty attractive. Having said that, I think Microsoft's shift is the right analog, clearly. And I think the question or the reality is most investors probably won't put them in the same camp as Microsoft. But to his point, I think if you can get some leverage in terms of the data applications with their existing customers, that's a much higher margin business. And so to me, that seems like the upside catalyst in the future. What's interesting, when we're speaking with Howard Marks of Oaktree later in the show, and one thing he wrote about in his recent memo is that there are different kinds of bubbles to talk about bubbles. There are bubbles
I knew we'd get there
that are we never left. Come on, we never left. There are non-productive bubbles, like what we saw in subprime mortgages, and then there are truly productive bubbles necessary to finance the the build out of key technological infrastructure and key technological advancement, those bubbles are more positive and can actually be invested in a more significant way. I mean, how much do you get the sense people are parsing through this and saying, okay, it could be frothy, but at a certain point, we're okay with that because the promise is significant?
You were doing a lot of anatomy of bubbles at the top of the show, so let me pick up on that. You mentioned froth. I mean, I think about the way these bubbles are connected, and I think that's what gives me pause as I think about this. So yes, you could have kind of a bubble circumstance in which some pop and others don't, but the fact that they're all touching one another strikes me as a problem here potentially.
No doubt. And so I think that's why we've been saying to stay diversified and keep some hedges on in your asset allocation. So agreed with you there, David. I think the other thing I would just say, however, is the policy tailwinds are still out there. And we've focused almost exclusively on monetary topics this morning. Let's not forget fiscal policy should be a tailwind going into next year. Perhaps not coincidentally ahead of a midterm cycle. So who knows what tariff revenue is left after the Supreme Court makes its decision. But we've also been hearing about tariff dividends as another potential backstop.
Yeah, well, tariff, schmariff, deficit, schmeficit, that's sort of what we're going to be talking about coming up in just a little bit. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Speaking of tariffs, Mexico has approved new tariffs on a wide range of Asian imports, a move that further aligns the country with U.S. efforts to tighten trade barriers against China. The levies will go into effect next year, and according to the legislation, Chinese cars will face among the steepest tariffs at 50%. Meanwhile, while the rest of the world prepares for the end of a rate-cutting cycle, China is teeing up the start of one. The country's economic policymakers have pledged to adopt supportive monetary and fiscal policy to lift weakening momentum, planning to, quote, flexibly and efficiently use interest rate and reserve requirement cuts to ensure sufficient liquidity. And a change in the C-suite at Coca-Cola. The beverage giant says CEO James Quincy is stepping down and will be replaced at the end of March by Henrique Braun, the company's chief operating officer. Quincy assumed the CEO role in May of 2017, and under his management, as you can see, Coke shares rose more than 60%. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, a fractured Fed.
The views are more varied. The situation is that our two goals are a bit in tension.
Everyone on the panel, on the committee, agrees to the facts, but we disagree on how to deal with the risks.
Claudia Sahm of New Century Advisors joins next. This is Bloomberg Surveillance. Futures fading ahead of Broadcom earnings later today. That Fed meeting not exactly keeping the lift after yesterday we saw a huge rally. Today pulling back about 0.4%. Still seeing that bid into bonds with 10-year yields at 4.13%. Under surveillance this morning, a fractured Fed.
The views are more varied. The situation is that our two goals are a bit in tension.
There could have been a lot more dissents in favor of no rate cuts.
I was hoping for a Fed that was more divided. There was scope to get greater dissent.
Everyone on the panel, on the committee, agrees to the facts, but we disagree on how to deal with the risks.
Here's the latest. The Fed facing three dissenters for the first time going back to 2019. Fed Presidents Austin Goolsbee and Jeffrey Schmidt voting to hold rates steady. Governor Stephen Meyer once again voting to cut rates by 50 basis points. Claudia Sahm of New Century Advisors saying we may have seen the last cut for several months, writing the Fed wants to wait and see inflation move toward 2% to cut again. If all goes according to plan, Powell presided over his last rate cut as Fed chair yesterday. Claudia joins us now. Claudia, great to see you. Thank you for being with us. I want to start, given that kind of backdrop that you think this could be his last rate cut as Fed chair, what did you make of his emphasis on the labor market and potential weakness there?
Right. Well, I think, Powell came out and really justified why there was yet another rate cut. They've had 75 basis points of rate cuts this year, a year in which we have not seen progress on inflation overall. So it really was important for him to justify the move that the Fed took yesterday. And I thought he did a good job of justifying that move, focusing on the weakness in the labor market, and yet also recognizing we still have a problem with inflation.
Claudia, there was this very dovish admission from the Fed chair as he talked about potential undercounting of jobs. And I'm curious what you made of that remark, that there could be an undercount to the size of 60,000. There could be sort of negative, I guess negative growth isn't the right phrase, but there could be sort of more problems with the labor market than we've seen thus far. What did that tell you? When he tipped his hand in that way, what did it say to you just about the state of this cracked labor market?
Well, I think it also just said how close a call this was in terms of doing another rate cut. So, I mean, the individuals, and Powell's clearly among them, that felt that the labor market needed a little bit more of a buffer. I mean, they had to strengthen their case, even from the last meeting where there was a cut. And so looking really hard at the payroll data and the potential biases that might be in there, just a matter of how the collection's done and, working through the process, I think they were just showing you that, I mean, really, they dug deep to justify this rate cut. And I don't think, there have been concerns about this voiced outside of the Fed. It was news that they were kind of digging into those details. Frankly, I thought the rising unemployment rate probably could have made the case for them alone, but it's good for them to show their work, all the things they're thinking about.
Help me with the phrase broadly neutral. We heard that from the Fed chair yesterday as well. Your sense of sort of, I know there's some ineffability when it comes to the neutral rate, but what did you make of that phrase that he used yesterday?
Right. Well, so yes, there's estimates all over the map in terms of what the neutral rate is. I think it's important that a lot of what's written down in the summary of economic projections, that's about the long run. We're not in the long run. Inflation is still elevated, and it's kind of inflation adjusted Fed funds rate that's important. And so there's really a lot of range. But what it's telling you is the Fed is recognizing that right now, where they have monetary policy, they are neither pushing down on the economy in a measurable way, and they're not pushing up on the economy in a measurable way either. They're kind of in a stance where they could go in either direction, and that's an important one. I think that's another way of the Fed underscoring the bar is really high for another cut.
Claudia, I want to just touch on a minute the intention versus the potential outcomes. And when I look at the world post-COVID in particular, given asset reflation, given massive spending on AI, it seems to me that like all the drivers of the economy today are rate insensitive. They're rate inelastic. When I think about the intention of this goal, of this rate cut, it's perhaps to get other parts of the economy, other parts of the consumer cohort stimulated, but I'm not necessarily sure that's going to be the actual outcome. What is the risk of more inflation coming out of this particular initiative, and then does that hurt people more than intended?
Well, I think a big lesson from this cycle in general, the last 6 years, has been that some really big drivers, both on inflation and in the labor market, are when we have changes on the supply side. Like a lot of the inflation that we had to deal with in the pandemic, and frankly, if you think of the tariff inflation as well, it's about cost pushing into the economy. That's not the Fed's tool with interest rates. Really is about moving around demand. Now, just because there's a lot of supply side, factors buffeting the economy doesn't mean the Fed should sit back and do nothing. But it does make the point that they're not kind of all powerful in terms of being able to smooth out the bumps in the cycle. So I think that continues to be a reminder. And also, the Fed is not going to solve the labor market. I mean, we do have slowing down in the labor market, but what they're doing by pulling out their restriction is they don't want to be a part of continuing, they don't want to be playing a role in further slowing. So, but again, it's these other factors in the economy are going to loom very large going into next year.
Claudia Sahm of New Century Advisors, thank you so much. Dan Skelly, thank you so much. You raise a really good point at the very end there, and hopefully we'll get you on soon to talk about it more, the idea of the financial mechanism, the financial transmission mechanism. How much are they actually going to bring prices down if you've got stocks near all-time highs? David, you're going to be sticking with us, of course, throughout the morning as we charge toward that 8:30 a.m. jobless claims. Do we get some validation of that weakness that Fed Chair Jay Powell was talking about? Coming up next, Steve Chiavarone of Federated Hermes, Libby Cantrill of Pimco, American Airlines Chief Executive Officer Robert Isom, and Michelle Meyer of Mastercard Economics Institute as we take a read on the consumer. Is it waning? Is it waxing? Which one? This is Bloomberg Surveillance.
This notion that the market can still travel higher without the AI trade leading, we're a bit skeptical about that.
We are, let's just say, we're waving the yellow flag. We're being cautious.
Any company that wants to keep a competitive edge needs AI.
Everyone's looking at how to incorporate this into their process. Next year, I think, is really going to be the year of the AI adopter.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks fading from yesterday's Fed-fueled highs as artificial intelligence fears take front and center. The Fed delivering a rate cut and less hawkish guidance, everything the market wanted. But Oracle reigniting fears of overspending in the AI space. Today, the focus turning very much to the economy with jobless claims on deck. David Gura here with us for the 3 hours. I'm so glad to say that you're with us. I'm just wondering how much we could see some of the fears that emerged from Oracle as being a good thing or a bad thing.
That's a great question. I hope we can talk about that more over the course of this hour. But you're right, we had this incredibly sharp reversal yesterday, and I think maybe that Fed meeting was a bit of a distraction to this conversation we had been having about the potential bubbleiciousness of this market and of the AI space in particular. Curious, as you say, what the chances are that this is kind of a proxy for the entire industry, and we'll see kind of make its way as other companies report here over the course of the day.
I like how you frame that, the sort of competition between the Fed and AI, and it's sort of these two narratives that seem to be neck and neck, trying to take the helm from one another. Yesterday, it was the Fed. We saw a rally that was the best one-day post-Fed rally going back to March. And then we saw Oracle reignite AI. At a certain point, are they tied together, given the fact that the Fed very much is looking at productivity gains from the AI story?
It's a great question. We saw reporters trying to get the Fed chairman to talk more about the prospects for AI, especially in the conversations about the economic forecast the Feds gave us yesterday. Wasn't really biting to the degree that I think a lot of people hoped that he would, but that marriage, that intertwining of these two things is something I think that we'll bear watching here in the months ahead.
Especially given the fact that there's huge division on the Federal Reserve. We had, of course, the dissents, 3 dissents, the most going back to 2019. But
and the quiet ones.
Exactly. The quiet ones definitely indicating there wasn't a lot of coalescing around one view going forward.
And the Fed chair kind of dismissing concern about that as well, saying that he thinks that's healthy, indicating there was kind of a robust conversation among policymakers, those who voted and those who didn't. But I think it is something that's going to be something that's more manifest over the course of these next few meetings, certainly in his tenure, and then with whomever takes over after that.
I feel like every time there are conflicts, people say that's healthy, and that's sort of what happens when problems arise. Right now, we've got a healthy sell-off, evidently. We have a dip in futures ahead of the open, led by the NASDAQ, but we can see S&P futures down by about 0.4%, a bigger decline in the tech space. NASDAQ lower by 0.7%. Russell 2000 doing better, and this is what you would expect, basically flat after the increased view on potential rate cuts after yesterday's Fed meeting. 2s, 10s, and 30s, you can really see a lift at the front end. Price yields lower. We saw almost an 8 basis point decline yesterday, 3.53%, less of a rally into the long end. Still looking at about 4.14% on the 10-year and close to 4.8% on the 30-year. And when you bleed it through the currency space, you see that dollar weakness reigniting back through that 117 level we broke through. It had been 116 at the previous Fed meeting, just eking in some dollar weakness. Coming up this hour, Steve Chiavarone of Federated Hermes as mixed Oracle results revive AI fears. Libby Cantrill of Pimco as President Trump interviews Fed chair candidates again and again. And American Airlines CEO Robert Isom as consumer demand remains resilient. We begin this hour with stocks sliding just a bit after weak earnings report from Oracle. Steve Chiavarone of Federated Hermes staying optimistic, even though he's sitting in the chair that I normally sit in, with a 7,800 S&P target for 2026. Writing, credit conditions remain benign. Valuations are elevated, but nowhere near levels seen in bubbles. This is a boom, not a bubble. Steve joins us now for more. Steve, love talking about the anatomies of bubbles. And, we're going to have to stress test that. To you, it's a positive sign that we're seeing Oracle getting punished after yesterday's earnings. Why?
Well, because it indicates that the exuberance is rational, right? I mean, if you look at Mag 7, right, they're positive cash flow, hugely positive cash flow. In fact, more cash flows generated in Mag 7 than the rest of the S&P. And their proportion is going up over the next 2 years, not down. And they're net cash. Now, take Oracle, for example. Well, that's a very different story. You're negative free cash flow. You've got a large amount of debt. And the market's punishing that. They're saying, OK, it's overspending because you can't afford it. It's not overspending for the other Mag 7 names. And so I think that discernment that you're seeing, that critical eye that you're seeing both on the bond market with the CDS and the equity market, that's evidence of a market that's acting rationally, not one that's acting irrationally. Bubbles are irrational, right? You reward bad behavior until it crashes. We're not doing that at this point.
So does it encourage you to take more risk in the AI space, or does it just convince you that you're not being reckless by investing in the broader tech-heavy index?
So, look, we've been on this idea of a broadening out for a while. So we were slightly underweight large cap growth for most of the last couple of years. We've used pullbacks, particularly the one that occurred around Liberation Day, to get slightly overweight there. We feel that that's good. Again, I think You're not going to get the kind of S&P returns that we're looking at, which is 10% or so over the next couple of years, unless these names are participating. And I think Mag 7 are strong, but that doesn't mean there aren't opportunities in cyclicals. That doesn't mean there aren't opportunities in small caps. And so we're overweight, but we don't feel like we're over our skis there. We feel like it's a good, kind of healthy place to be.
I'm going to keep ringing this bell about timing over the course of the morning, but you look at a company like Oracle, which has really gone through this metamorphosis or self-reinvention, I think playing up the cloud part of its business to kind of benefit its complementarity with AI and the potential growth of AI. How do you think about timing? So you talk about the lack of free cash flow, the amount of money that they're pouring into this, the debt that they're putting into it. What kind of patience do you have, do you think people should have as this begins to evolve and grow?
Again, I think you have to think about Oracle and its particular issues in the rest of the Mag 7. Remember, the rest of the Mag 7 had businesses and have businesses that were doing extraordinarily well and generating records amount of free cash flow before ChatGPT was ever launched. And so, okay, let's say that they were overinvesting and had to pull back. What are you left with? Even better free cash flow generation from 7 great business models. Oracle, on the other hand, was struggling, right? It had a software business that wasn't reaccelerating. So if AI doesn't pay out, where does that really leave them? And I think that that's the difference. Again, we saw this, and you see it with companies like Apple, you see it with some of the other names in the Mag 7. There's just good underlying businesses there which allow you to be very patient and say, okay, if AI revenues don't come for a year and a half or 2 years, well, I'm still making a ton of money on the legacy business. For Oracle, I don't think that's the case. So again, I think it is that discerning, though, David, that indicates a healthy market, not one that's irrational.
Let me move from the mega caps to small caps. Lisa put up the Russell 2000. It did have a huge bump on the heels of that Fed meeting. It was up by 1.3%, and there's been this roiling narrative, when are small caps going to take off? How do you look at those companies in particular? What's going to be the catalyst that's going to make the move and sort of stay higher?
So I'm going to defy the bearish chair here, if you will, and say, one, I would not be surprised at all if the market finished higher today.
Interesting.
And small caps are one of the reasons why. You see that they're leading in the pre-market here. They led yesterday. In fact, if you look at since Liberation Day, they've kind of kept pace with large cap growth. And it's the first time, and it's been very quiet and maybe underreported, that you've seen small caps have a sustained rally now for 8 months. And I think the big news for them yesterday was the purchases on the short end of the curve. And I know it's not QE, and I know the official line and all that, but small caps have high variable rate debt that's tied to the short rate. You're buying bonds on the short end of the curve. You take that short rate down. We've seen the yield curve steepen a little bit with short rates falling more, and that provides relief. So I think you've got an economy, and the Fed recognized this yesterday. You have an economy that's reaccelerating a little bit. They had to raise their GDP estimates, and you've got rates that are lower now. I know they only have one cut in there for next year, but it's going to be more than one. And that really does help the small caps. I think you've got a cyclical uplift coming in 26. I think they can continue to play well.
What are we calling it if not QE? You did the quotation fingers QE yesterday.
Oh, yeah. Well, I mean, they went in to say, please ignore everything we're about to say.
Yeah.
And then they said, we're bringing forward our timing of buying up $40 billion of T-bills. And by the way, it's significantly more than we expected. And by the way, it's probably not going to stop for quite a while. But ignore this part of the story. And everyone went, woohoo, party like it's 1999. And I just wonder, from your perspective, going forward, how much any kind of rotation is underpinned by this idea that the Fed wants to run the economy hot at a time of technological transition that could ultimately cause job losses, right? I mean, they want to keep things robust so they don't get that kind of scarring in the labor market.
So Powell didn't really say it with his words, David. I think that was your point earlier. But the dot plot said it very loudly. Not the dot plots, the economic projections. They're building higher productivity into those numbers, right? I mean, you have growth estimates from the Fed that are accelerating, and you had inflation estimates that are coming down. And I think if you look at some of the new Fed chair candidates, which I'm sure we're going to talk about a little later, I think those, particularly if you're talking about someone like Kevin Hassett, I think he's more than willing to really start to forecast those productivity gains. And so I think that does allow you to run rates a little bit lower, kind of like what you did in the 90s. I think the other element here, too, and we got to remember this, just because we can't imagine the jobs that AI will create doesn't mean that they won't be created. History, technology has evolved in a positive direction for 2,000 years. Lisa, do you feel like you don't have enough work to do these days?
We'll leave that.
Don't answer. Don't answer
that. I think, there's not going to be any shortage of things for people to do. We'll figure it out. And if you have the new idea of what those jobs are going to be, congratulations, you're the next billionaire. So, yeah, there'll be some creative destruction, but this idea that, massive amounts of people are going to be out of work because of AI. History just argues very strongly against that.
You just turned this on its head, made people hope for that kind of creative destruction where you get a robot. Hello, good morning. Welcome to Bloomberg Surveillance. Steve Chiavarone of Federated Hermes is sticking with us for the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Eli Lilly reporting its next generation obesity shot helped patients lose nearly a quarter of their body weight, more than what was expected. This latest trial included patients with obesity and knee pain. The results help cement Lilly's dominance in the obesity market that's expected to hit $100 billion by 2030. Meanwhile, President Trump weighing in on the bidding war for Warner Brothers, the president saying he would oppose a deal that doesn't include new ownership of CNN, creating a potential issue for Netflix's bid. The streaming giant's plan includes a spinoff of Warner's cable channels. Paramount, for its part, is trying to buy the company outright for $30 a share. And the Trump administration is now accepting applications for Gold Card visa applications. The program offers residency permits for a price, with individuals paying $1 million and businesses paying $2 million, as well as a $15,000 processing and vetting fee. President Trump says the program is critical to helping businesses hire foreign-born graduates of American universities. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Honest with interest rates.
I'm meeting with Kevin Warsh today. I'm looking for somebody that will be honest with interest rates. That's all. Our rate should be the lowest rates in the world.
Libby Cantrill of Pimco joins us next, plus Steve Chiavarone on his detailed forensic analysis of why rates should be substantially lower. Right, Steve?
No.
You're watching Bloomberg Surveillance. What a round trip it's been over the past 24 hours. Some trepidation heading into the Fed meeting, then jubilation that you got a rate cut and some more dovish commentary. And then Oracle slapped that down with an expectation of more spending without commensurate revenue increases, now down 0.4% on S&P futures. Dollar weaker, but just slightly. 117 on the euro dollar cross. The bid into bonds is real. It is concentrated at the front end of the yield curve. You're seeing a steepening, even though yesterday you saw an 8 basis point decline in the 2-year. On the 10-year, it was just a couple of basis points. Continuing that bid today, 4.13%. Under surveillance this morning, Honest with interest rates.
Well, I'm meeting with Kevin Warsh today, so I'm meeting with him. I sort of have a very good idea what I'm looking for. Again, I'm looking for somebody that will be honest with interest rates. That's all. I just want honesty. Our rate should be much lower. Our rate should be the lowest rates in the world.
Here's the latest. President Trump meeting with finalists for the next Federal Reserve chair, including Fed Governor Kevin Warsh. The president saying he could announce his nominee within the next 2 weeks. Bloomberg's Tyler Kendall joins us now. Tyler, this seems like the story that just won't go away. It's going to happen in the next couple of weeks. It's going to happen early next year. The final round's happening now. It's happening next week. It's happening next year. Where are we in this flow chart of the Fed game?
Well, I think that actually was a pretty good summation of where we are, Lisa, because President Trump has echoed things and then has changed the timeline, for example, saying that we could hear early next year. Now it might come within the next 2 weeks. But what we do know is that he's reiterated one through line in the past couple of weeks, which is that he already has a pretty good idea of who he would like to see replace Jerome Powell. He also went on in that bite that you played to say that he is not making any of these candidates take a pledge to cut interest rates, though earlier in the week suggested that a quick reduction in borrowing costs would be a litmus test for any new Fed chair. Now, as you well know, in addition to former Fed Governor Kevin Warsh, the other candidates include current Fed Governors Chris Waller, Michelle Bowman, BlackRock's Rick Rieder, and of course the apparent frontrunner in all of this, NEC Chair Kevin Hassett, who in recent days, I think it's fair to say, has tried to put front and center this idea of central bank independence amid concerns that he's too close to President Trump as a key ally and longtime advisor to both the first and Trump administrations, and that he could cut rates too aggressively. We heard from him earlier in the week at this Wall Street Journal event saying that one of the most important jobs of any Fed chair is to stay out of politics, yet at the same time still aligned himself with President Trump's repeated call for lower borrowing costs. Now, Lisa Powell's term as chair is up in May of 2026. I think it's important to point out that Bloomberg News is reporting that whoever is chosen to replace him is expected to take the slot that opens up on the Fed Board of Governors that's currently held by Stephen Meyer, who's only on temporary leave from the CEA. That slot becomes available in early January.
Tyler Kendall, great reporting as always. Thank you so much. Libby Cantrill of Pimco joining us now for more. Libby, thank you so much for being here. Why not just give the role to Kevin Hassett at this point?
Well, I mean, look, I think that this is obviously, President Trump loves a horse race, and I think he loves the drama. And of course, he doesn't need to nominate anybody until Powell's term is up, which is, of course, as you know, not until May of 2026. And so there really is no rush here. But I do think this is, sort of speaks to the dramatic that the president likes. I mean, I do, kind of a broader issue, though, is sort of these rumors that there has been kind of pushback on Hassett. I think it does show that even though the market has been pretty sanguine about Fed independence, that there may be some concerns, and that when you have somebody from the White House that then rotates to the Fed, that there could be some politicization of the institution.
Libby, you hear from the president saying that what he cares about, somebody honest about interest rates. There's more to it than that, of course, and I think that there was a narrative for a while that this was going to be a reformer. And I think Kevin Warsh represents that. He's somebody who's talked a lot about the way the Fed is structured and what could change. Do other candidates share those same inclinations? How much does the president prize that? I should say we heard from the Treasury Secretary. He's interested in reforming the way the whole system is set up, who can be regional presidents and the like. How big an issue is that, do you think, for the president as he goes through this surge?
Yeah, I mean, maybe not for the president himself, but I do think for this administration, and I think for many folks on the Hill as well. I mean, this has been a long time in coming. Obviously, Congress has tried to pass legislation to reform the Fed that requires 60 votes, so they haven't been able to get kind of bipartisan support. But I do think we could see some reforms. But I do, it's important to contextualize what the reforms could be and what is possible. There's just not as much that the president or a Fed chair can do unilaterally without actually changing the law. And of course, you need Congress to change the law. So could we see sort of incrementally how reserve presidents are chosen, maybe a little bit more pressure on reserve presidents? Of course, the Fed board does have authority over sort of who stays as a regional president. But I think just by and large, there's probably, I think, we're expecting more incremental reforms, sort of, if any, just given some of those constraints.
So let's say Hassett's the front runner, which Bloomberg has reported, and you point out the fact there's been this kind of growing concern within the bond market about him as a potential Fed chair. That kind of became something we first saw in the FT piece a couple of days ago. Now seeing that broaden a little bit more. What does the bond market want to see? I think of what Anna Wong, our colleague at Bloomberg Economics, wrote, saying, look, she knows Kevin Hassett, she's worked alongside him. Actions speak louder than words. He's somebody who has talked a lot about Fed independence and has prized it through the entirety of his career. He did advise some more traditional Republicans in years past. What does he have to do to kind of assuage or pacify those who are concerned about the prospects of him being the next Fed chair?
Yeah, I think as you know, there's what he says publicly and what he says, to the media, and in this, should he get nominated, that all-important confirmation hearing, but also what he says privately, and to the very key Republican senators who will effectively cast sort of the vote, whether he gets nominated or not. So I think what they want to see is, again, just reassurances that that he will uphold independence, that he will not be sort of assuaged by whomever's in the White House, because of course this next Fed chair will outlive President Trump's term and will be in for whomever is president in 2029, and that also that some of these rumors about the regional presidents and what have you again maybe the reforms will be more incremental and not necessarily existential.
Libby, how do you think about the bond market and its reaction to all of this? For all the kind of rumors of pushback since Bloomberg broke the kind of Hassett news, 10-year yield has been relatively well-behaved. 2-year yields are relatively well-behaved. I think, the WIRP is still pricing in kind of a 3% terminal rate. It seems like the bond market is taking the kind of measure of Hassett and saying it's not a really significant shift in policy, and bond market seems relatively comfortable. How do you react to that?
Yeah, I think to what I just said earlier, I do think the bond market has been relatively sanguine about this, just about in general, this fear about Fed independence. And I think that, maybe underscores two things. One is that oftentimes the market doesn't believe anything until they actually see it. And so they're not going to necessarily just trade on speculation or on rumor. And of course, we don't even have a Fed chair nominee yet. It's all just been kind of this, of course, the drama. But I also think the number two is that the market understands some of these guardrails that are in place, and that while the chair, of course, is very important, the chair is not kind of almighty in terms of changing monetary policy, and that, of course, it is the majority of, as you know, the FOMC, 12 members, not just the 7 Fed, board governors, and then also, not to overstate this sort of confirmation process, but something I, maybe to their chagrin, always reinforce to our investment committee is that this advice and consent role that the U.S. Senate plays is very important. And actually, if you just look at the number of nominees that this president has had to withdraw, it's really unprecedented. And it's all kind of been back channeling in private, but that sort of speaks to the fact that they have not had the votes in the Senate to confirm those nominees. So I think if somebody were to be nominated who would be sort of too political, who would really compromise the independence of the Fed, I think the bond market is reassured that the Senate would push back.
This goes to a bigger question, and I was glad that you went there, about how much Republicans are starting to push back on President Trump after some of the recent elections and some of the recent losses on the part of certain Republican candidates. Do you get the sense that there is a greater constraining of some of the more extreme policies by Congress as a result of some of the recent elections?
I do. I think the political runway for this president is absolutely shortening. But I would also say that this is very consistent with history. If you look at Biden's administration, the Democrats, of course, had both the House and the Senate in his first 2 years. And they basically allowed Biden to do whatever he kind of wanted to do, right? To really advance his policy agenda that first year. However, as you got closer to the midterms, as you had some of these sort of off-cycle elections, the Democrats really did start pushing back on President Biden. I think that's the corollary here, the parallel, is that, Republicans have been pushing back on the president sort of privately, but I think we expect them to do that more, more publicly. But again, this is not necessarily President Trump specific. This is kind of just the political cycle in Washington.
Libby Cantrill of Pimco, wonderful to see you as always. Steve, I'd ask you then, does that constrain how many hopes and dreams there are for fiscal stimulus come early next year?
No, I think you might see a little bit more of an impetus after these kind of off-cycle elections. I think you're probably seeing Republicans getting a little bit nervous in the House and Senate and wanting to positively impact the economic lives of folks that are pretty frustrated. So I think you could see another impetus there. And then I'd say on the whole Hassett thing, I think we're trying to make a little bit more out of it than there is. He's
with us here, Steve.
Well, Lisa, he's a mainstream candidate. I think he's the second most cited, sell-side economist since Milton Friedman. He was AEI. It's not like he's from some, off-the-wall place. And I think the market has demonstrated, at least so far, relative comfort. So, I'm sure these interviews are important. As always, things can change, but I think this is just legitimizing him at this point.
Well, that's the reason why I think a lot of people think it's a trial balloon, continually being put out to see how the market responds. Coming up, we have an exclusive one-on-one interview with American Airlines CEO Robert Isom, a true read on the consumer. Going forward, the bookings are strong. Plus, Yahaira Anand with your morning movers shares a Broadcom taking a hit ahead of their earnings as AI bubble fears continue to grow. More analysis of bubbles coming up. Pulling back from some of the earlier lows, seeing a bit of a bid as the day grows older. As Steve was saying earlier, maybe we will end the day in the green with some of the naysayers of big tech getting pulled back. Right now we're seeing about a 0.25% decline on the S&P, a bit into bonds, a bit of dollar weakness. And even with everything going on with Venezuela, oil prices, crude traded on the NYMEX down 1.1%, 2 hours away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Oracle's disappointing results hitting the AI trade this morning. Oracle says it plans to add another $15 billion in spending through 2026, bringing CapEx to $50 billion. And that is stoking fears among investors because they think the returns are just not showing up fast enough. And that is why we are seeing shares of NVIDIA and Meta, big AI spenders, lower this morning. And Oracle's results don't bode well for Broadcom, which reports after the bell today. Those shares are down 1.4%. Meanwhile, moving on to Gemini Space Station. No, this is not a space company, as you said, Lisa. This is a crypto firm run by the Winklevoss twins, and shares are surging 14% in the pre-market after regulators cleared the firm to launch a derivatives exchange, opening the door to potentially it entering the red-hot prediction market, already dominated by the likes of Kalshi and Polymarket. And we end on Eli Lilly. Those shares are up nearly 2% on some news this morning that its next generation obesity shot topped expectations, helping patients shed nearly a quarter of their body weight and drastically reducing knee pain. Lilly says that some patients lost so much weight that they actually dropped out of the trial. Lisa?
Thank you so much, Yahaira. I'm thinking about what a surveillance space station would do. It could create some sort of new technology that could generate a space-like feeling after doing it for too long. I think that could be good. Anyway, moving on. On our radar this morning, Oracle reporting a jump in spending on data centers, reviving AI bubble fears among investors. The company's fiscal second quarter cloud sales and its infrastructure both falling short of estimates. Those shares building on losses, even with the rest of the index climbing back down more than 12%. Meanwhile, U.S. forces intercepting and seizing a sanctioned oil tanker off the coast of Venezuela. The action may make it harder for Venezuela to export its crude.
What happens to the oil on that ship? Well, we keep it, I guess.
Where does it go? What port does it go to?
Well, you have to follow the tanker. You know, you're a good newsman. Just follow the tanker.
Venezuela calling the seizure a, quote, blatant theft and an act of piracy. Meanwhile, President Trump slamming Fed Chair Jay Powell over the FOMC decision to lower interest rates by 25 basis points.
The head of the Federal Reserve is a stiff. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
The president saying a decision on Powell's replacement could come within the next 2 weeks. We do want to turn to airlines. Carriers are gearing up for what is expected to be a record-breaking holiday travel season. I sat down with the American Airlines CEO, Robert Isom, to talk about consumer demand. Take a listen.
We're really pleased with how we see the Christmas and New Year holidays shaping up, and even more so as we take a look out into the first quarter of 2026. You know, the government shutdown, it had a dampening effect on demand, but I really like what I've seen in terms of bookings post that, and we're ready. You know, an airline is a big, complex operation, and it takes people and equipment and, you know, systems to all be working. We've double, triple checked, and I'm so proud of our team. They're ready.
So we've heard from Delta, we've heard from United, we've heard from a number of other airlines about the hit to revenues in the fourth quarter as a result of the government shutdown. I don't believe that American has come out with anything like that. Do you have some sort of estimate of what type of revenue was lost due to the cancellations during the government shutdown?
Well, it's just been a month ago that we were talking about our third quarter earnings and talking about what we were envisioning for the fourth quarter, and really optimistic about bookings that had happened. And at the time, we were, you know, in the midst of government shutdown, but the impact was fairly light. You know, at the time, we were saying less than $1 million, you know, per day. But as things developed, and then we got to the mandated pullbacks, look, there was an impact, and it was substantial. And it not only was it for the day of travel and the cancellations that might have happened or the disruptions, but it was also for the bookings that would have happened during that period. And so there was a dampening effect during the period. Again, the good news is that as soon as we get out of that disruption, as soon as we get to really having an airline system that people have confidence in, they come back to travel. And so that's what gives me great optimism for the holidays and as we look into the first quarter.
I have to be honest, when I talk to people in the industry, the sense of palpable frustration that this is sort of the hot potato in any kind of negotiation is really notable, especially heading into potentially another government shutdown in January. Is there anything you could do to get ahead of it?
Well, I don't like that. aviation is critical infrastructure to the country. And I think everybody in the administration, everybody in the House and Senate realize that. We have to do the things to keep critical infrastructure running. And while it's commercial aviation, I'd also say, other, really important industries, drones and eVTOLs and anything that's taking into account air mobility depends on air traffic control. And we can't use it, really as a battleground. So I'm confident that our politicians will get together and figure out a way. It starts with protecting our air traffic controllers. Nobody should be asked to come to work and not be paid. And nobody should be used as a pawn in a political negotiation. So I'm really hopeful that by the time we get into January, this will be long behind us.
In the meantime, the airline industry is incredibly competitive, as you know. And we've heard Delta and United talk about their premium offering, talk about increasing their revenue. United in particular, Scott Kirby has come out and said that United and Delta are kind of taking off and apart from American Airlines. How are you fighting back, given that that's the backdrop that you have?
Well, wouldn't they like to be so? It's absolutely not. It's absolutely not true. And as a matter of fact, you take a look at American Airlines history. We're the ones that developed the frequent flyer programs and airport lounges and the hub and spoke system and global distribution systems. There's just an ethos of innovation at American Airlines. And really the investments that we've made over the last decade are all set to come about and be ready for where customers want to go. So I was flying back from London over the weekend in our new flagship suite on our 787-9P. And I can tell you that hands down, that is the best product among any of the network carriers in terms of experience. This year, we've announced the opening of the new Philadelphia flagship lounge. We've got a Miami flagship and a Charlotte flagship coming. Nobody has more premium quality lounges than American Airlines. We're going to do a better job of packaging this all together. We have an extreme focus on customer experience. We've got a new organization that's just totally dedicated to that. And just about every week there's a new announcement with Lavazza Coffee, our Champagne Bollinger, or Raven and Lily amenity kits. I'm really excited about that all being packaged, and us, certainly, talking about that in a fashion that people understand. We've got the best loyalty program, we've got the best product, and it's where people should be flying.
One thing that American Airlines has for it is it's more focused on the domestic regime than some of the other competitors. And I'm just wondering if there's an effort to sort of expand the international network as that does become a higher margin offering for so many airlines.
Well, that's right. And this year, that exposure to the domestic region, it had an adverse impact on us. We didn't have as much international exposure. International did very well over the course of the year. Domestic, not so much so. We had uncertainty, the accident with 5342. So there was a lot of things that we had to overcome, and we've done that. But I feel really good about where we're headed. And when it comes to international, we're ready. So not only are the 787-9Ps delivering, but tomorrow we've got a big announcement on our 321 XLR aircraft, and those are coming out as well. So you'll see us open up more secondary cities in Europe. You'll just see us do more flying into the hubs of some of our partner carriers. And international will probably outgrow what we do from a domestic perspective, but the two are connected. And I'm really pleased with our domestic operation. We're going to always have the best domestic network. And you go back a number of years, and domestic outperformed international. And we're going to be ready for domestic doing well and international doing well, premium doing well, and really pleased with where we're at.
You've been working on upgrading the entire fleet, and that's something that's been really important for you, especially as you get some of these premium offerings in place. How much have some of the slowdowns, supply chain issues at Boeing and Airbus hampered that ability to really retrofit some of the fleet?
Well, where we stand today, we have the youngest fleet in the industry. We made a tremendous investment from about 2014 to about 2020. And we brought on well over $30 billion of new aircraft. So we have the youngest fleet in the business right now. But on top of new deliveries that we're taking, we don't have any retirements planned. So we're reconfiguring our 777-300s and our 777-200s. We're putting flagship suites on those. Even domestically, we're doing work on our 320s and 319s. But we still depend on new deliveries. And from that perspective, we have a lot of dependence on Airbus to deliver the 321 XLRs, Boeing to continue to deliver the MAX 8s, and hopefully, be ready to deliver the MAX 10s that we have on order in 2028. Right now, my only push to the OEMs is deliver on time, deliver a quality product, stick to it. Before you ramp up, let's make sure we can do what you're on the books to deliver now.
Just taking a step back, in the airline industry more broadly, there's been this huge focus on the supreme product, the luxury product. And I wonder what you see in terms of bookings next year, whether it really is the premium product that's continuing to lead and the robustness that you see there while other things fall off. Is it bifurcated in terms of the bookings and the demand, or do you see a wholesale sort of rejuvenation in the interest in travel and ability to spend and pay the prices that actually are there?
Well, I'll just start with this. Demand has been resilient, right? Every time there's cold water poured on the environment, it seems like travelers want to come back, as evidenced by bookings for the holiday season, and as we take a look into the first quarter of next year. I have confidence, though, that overall people want to travel. And in people wanting to travel, I also think that, whether you're more economy focused and budget minded or you're premium services, everybody wants more. Everybody wants better control. Everybody wants more comfort. So I don't think that there is going to be any going back in terms of offering product at any level of the spectrum of offerings. But for us, as we go forward, you'll see us with our lie flat seat offering. That's going to grow by 50% over the next few years. Premium seating, 20% over the next few years. Whether you're a business traveler who've always wanted, more of that, comfort and ease of touch, or you're a leisure traveler, there's much more of a demand to really have a better experience. And we're going to meet them there, no matter how you take it.
That was American Airlines CEO Robert Isom, and we were really looking at the consumer at a time where that's a huge question going forward. Steve Chiavarone still with us. And Steve, I want to get your take on the consumer. We've heard kind of mixed messages, Dollar Tree, Dollar General doing better. At the same time, how much are we seeing any kind of revival in consumer spending led by the top end continuing, or is this broad-based? Is this also happening in the lower income cohorts?
No, I think this might end up being the big contrarian call of 26, actually, is a rejuvenation of the consumer and consumer-related stocks. You look through, rates are lower, which takes some borrowing costs off. Starting in January, and people forget because the bill passed last July, but starting in January, you have about $150 billion annually in stimulus hitting, and it really hits that middle consumer, right? That $100,000 earner, maybe it's a policeman, maybe it's a fireman who's making $100,000, but now all of a sudden that overtime isn't taxed. Plus, on this travel, leisure, and kind of entertainment business, you have an Olympics, you have the World Cup, and you have America 250. You put all of that together on what's already been a pretty strong Black Friday season here. And I think you've got a story of a consumer that awakens again next year, and you're seeing it in the airline data, especially after people are feeling that pent-up demand after the kind of government shutdown, which delayed air travel. So I think the consumer is the contrarian call next year. I think relief is coming. I think there's a lot of bad news that's already baked in, and I think you're going to see a surprise here to the upside.
David, are you flying a lot for fun?
Not a lot for fun. I mean, I still don't find it that fun to fly, especially if it's for personal travel. But I am curious, we talk a lot about the K-shaped economy in an observational way. Mm-hmm. And I think what's been driving that sense that everyone has of that largely is sentiment data, how consumers feel. Is what you're positing that, when these tax benefits come into effect, have that stimulative effect, it's going to change the way that people feel about the economy?
Yeah, because I think we forget, because we're doing this all the time and we're focused on every policy announcement and every economic data point. But for a lot of Americans, all right, there was talk of a tax bill. That was back in July. Right. Maybe they forgot about it, or maybe they're not focused on it in their day-to-day life. Then all of a sudden, January 1st, that first paycheck has some more money in it. And then you find out in April that some of the provisions of that tax bill were retroactive and are going to get paid back in the form of a larger tax return. So I think you could see a kind of positive sentiment shock as that paycheck is just a little bit bigger, goes a little bit further. And the consumer's retrenched in what I would call affordable luxuries. You see restaurant spending down a little bit. Mm-hmm. They may want to go back out and eat, and I think you're going to see that kind of play out in the first quarter.
And this goes directly to challenge what we're going to be talking about up next, a global growth slowdown.
I believe that 2026 will be another year where there will be both strength and risks. If in 2026 we don't figure out a way for countries to work better together, we really are moving towards what I would call slow and silent decoupling.
Michelle Meyer of Mastercard Economic Institute joins us next. This is Bloomberg Surveillance. Can't keep a good market down. That's essentially the takeaway from equity. Futures actually have moved way off some of the earlier lows. They had been down about 0.5% on the S&P. Now we're seeing futures off just about by 0.3%. You're seeing that ongoing dollar weakness, and the bid into bonds is strong, and it's strengthening throughout the morning. 2 basis points of a decline on the 10-year, 4.12%. The rally really has been at the front end, but still there is a participation along the curve. Under surveillance this morning, a global growth slowdown maybe.
I believe that 2026 will be another year where there will be both strength and risks. Strength from the fact that we still have the AI capital expenditure that's happening. You have governments around the world that are also doing much more fiscal spending. If in 2026 we don't figure out a way for countries to work better together, we really are moving towards what I would call slow and silent decoupling.
Here's the latest. Investors looking ahead to next year's growth as the impact from tariffs and tech advancements take shape. The team at Mastercard's Economic Institute predicting moderate global GDP growth at 3.1% in 2026. A key dynamic is continued trade realignment between the U.S. and China. Joining us now is Michelle Meyer. And Michelle, wonderful to see you as always.
Yeah.
I would love to get your take on what Steve Chiavarone was just talking about, which is that he thinks the stealth story is the recovery and acceleration in the consumer in 2026. Are you seeing that in any of the data that you're collecting?
Yeah, I would say it's probably not a stealth story. It's a reality. And I think it has been the reality that consumer has been extraordinarily engaged. You just heard it from Robert Isom in the interview you aired that consumers are still traveling. You are still seeing the embrace of discretionary spending in addition to the necessities. So it's consumers that, again, it's going to vary depending on the income cohort. It's a big part of the narrative that it's not even. It never is even, frankly. But you have consumer spending that is still running at a healthy clip. For the holiday shopping season, we're looking for a mid 3% pace for holiday sales. Black Friday came in. With our data, we saw a 4.1% increase in spending on Black Friday.
How much is this inflationary? How much is this because simply the prices were higher, not necessarily more items were ticketed?
So, we'll find out for sure once we get the CPI report at some point.
Yeah. I was about to say, do you know when it's going to be? I don't think it's going to be.
We'll know at some point. But in the interim, what we know as of now in terms of the basket of holiday shopping items that we typically see, inflation's running maybe around 2% or so year over year. So certainly there's very much still real spending and growth in terms of volume.
When you look at where people are spending money, what's the story that emerges from that? So you talk about how kind of discerning consumers are being, about where they're spending it on what.
Yeah.
Can you break that down by, I don't know, strata or sector? What can that tell us just about people's habits at this moment?
Yeah, so I certainly think that consumers are savvy. I think they have been savvy this whole period of time coming out of the pandemic once they experienced that price level shock that was, challenging for them. It was the first time consumers saw a significant increase in the price of goods across the board. And since then, I think consumers have been really mindful in terms of what they buy, when they buy, why they buy it. They certainly concentrate spending around promotional periods, which is what we saw during the Black Friday period. But, making those choices that work for them.
As you look at kind of the evolution of consumer psychology in this moment, I think there was a lot of anxiety surrounding the prospect of what tariffs might mean for all of us.
Yeah.
Has that eroded? Steve, just a moment ago, talking about how people might feel once these tax benefits come into effect. Are we at a point where the immediate effects of those tariffs are now not front of mind for a lot of consumers? It's not as big of kind of a psychic weight as it was at the beginning of Liberation Day and the like.
Well, I think we've moved from the headlines, the uncertainty, to the reality, right? So now we're actually seeing that enter into the economy. It's still happening, but there's a little bit more stability in terms of the process. And I think for consumers, what they're focused on is when they walk into the store, they try to purchase something online, what is the price and does it make sense for their budget? And if it's an item that prices have increased, whether it's because of tariffs or because of other reasons, they might say, you know what, does it make sense? How badly do I want it? Or can I buy something else where I feel like I get better value? So that decision is always happening. And in a world where there's more digitalization, where you have a greater share of spending that's happening online, more choices that are out there for consumers, I think they have a little bit more power to navigate this environment.
You talked about the kind of unevenness of consumer spending by kind of income cohort, and I'm interested in what trends you're seeing, at least over the holiday season. You know, is the high end focusing their spending in a particular place? Is the lower end consumer, are they still healthy? Where are they spending? Break that down for us a little bit. Give us an understanding of kind of how the high end and the low end consumer are behaving through this holiday season.
Sure. So, I mean, we don't have the ability to break that down specifically with our own aggregated data. But what we do look at is different baskets of spending and how that varies across the U.S. in terms of different locations, which could be a nice proxy for income spending. And, you know, this holiday season, I would say it has been a lead-in has been experience spending has done well. So we've seen a good amount of spending on restaurants, travel, lodging, a bit weaker in terms of furniture, home improvement, footwear. So some of the more discretionary goods categories that may have tariff impacts where perhaps the value isn't as notable. And then apparel has been a really strong one this season. Feels like kind of across the board as well, where we're seeing this engagement in terms of greater spending on apparel.
So we shouldn't necessarily look at all the sales as being just people trying to reel in consumers that are reluctant. I mean, when you have things in your basket in Amazon or some other company, how many times do you get emails?
Often.
From people saying,
quite often.
You haven't checked out. The deal's still there 15 days
and
after
how
Black
often
Friday.
Does that work?
Well, that's true. Michelle,
In a desperate moment.
That's true,
you know?
exactly. It's like, well, like people get more desperate. Michelle Meyer of Mastercard Economic Institute, thank you so much. And Steve, this really goes to the point that you're making, which is you think that there is going to be this boost. Why then aren't you even more bullish? We have 8,100 from the likes of John Stoltzfus. Why aren't you the biggest bull?
He's in that chair.
That's absolutely right. The chair is dragging
weighing
me
you down.
No, look, we've got a 2-year forecast of 8,600 out 2 years. I think the story here is you just can't push the multiple that far. So, you know, we've got an earnings estimate that's sitting, you know, roughly 10% above the street. We've got a multiple that's about flat to where it is now, which is a pretty good multiple. You know, I think that's good enough for now. If there's an upside surprise, that's great. But the reality is we're 6% overweight equities, which is 60% of our max. I think we're well positioned.
Steve Chiavarone of Federated Hermes, thank you so much for being with us
for having me.
This morning. Always wonderful to get your thoughts. And we're heading into, of course, 8:30 a.m. We get jobless claims. And that's where really the proof meets the pudding, or whatever the expression is. Because right now, it really has to do with whether the labor market holds in.
Yeah, and still in this moment where we're not getting the data that we expected to get when we were supposed to get it. So I think that's still, there's a fog surrounding all of this. So each of these data releases, I think, takes on kind of an added level of importance.
Yeah, well,
it's something.
Yeah, it's at least it's something,
yes.
right? I love it. We'll see in the CPI that we'll get at some point.
True.
We will be getting jobless claims, and that will be coming up in about 35 minutes. Coming up, we're going to be speaking with Kristen Bitterly of Citi Wealth at Work, Goldman Sachs Vice Chair Rob Kaplan, Blerina Uruci of T.Rowe Price, and co-founder and co-chair of Oaktree, Howard Marks. This is Bloomberg Surveillance.
Today, the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point.
Nowhere near as bad as the market feared.
But they really want to tell us that the base case is a hold for January.
The first takeaway is the pause is in.
I think you could see some more rate cuts in the back part of next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks fading from yesterday's Fed-fueled highs with AI fears front and centers, but climbing back from some of the earlier losses. The Fed delivering a rate cut and less hawkish guidance. That's the good news. Oracle, however, reigniting fears of overspending in the AI sphere. Today, the focus turning very much to the economy with jobless claims on deck. David Gura with us here. And David, to me, this really is the question. At what point does the economy meet some of the optimism that we're seeing in equities, barring maybe Oracle and some of what we saw yesterday?
Yeah, and I think these jobless claims numbers taking on a bit of an outsized role here in light of what the Fed chairman said yesterday, this kind of notion that maybe there's been an undercounting of jobs, overcounting rather of jobs in this country, what that could mean if we're seeing negative growth in the labor market. I think making people once again recognize the fact that, yes, there's this dual mandate, but the Fed is in this very tricky position here of having to operate somewhat blindly at a time when there are real concerns with what's going on in the labor market.
I think it's interesting what Steve Chiavarone said, and I think we should sit on it for a minute, when he said it's a good thing that we're seeing Oracle punished for spending more at a time where its revenues are not keeping pace. This shows discernment in a market that really defies the calls for an all-out irrational exuberance that you typically see at the top of a cycle. This is what we're hearing from an increasing number of investors.
I think a hopeful commentary there from Steve. We'll see if that sort of plays out as the day goes on and we look at these other companies in the AI space that are reporting earnings here in the days ahead. But there are plenty of people, as you know, who are concerned with the fact that this does seem very bubbly, and this is something just like another alarm of concern for them as they watch this unfold.
Throwing money at the hopes and dreams of technological advancement that we can't quite put our fingers on. About half an hour away from those jobless claims, we also do get a host of Fed speakers coming back to the podiums after the quiet period is over. Coming up today, we will be hearing from, in particular, Austin Goolsbee. Watch this space, given that he was one of the three dissenters at yesterday's meeting. S&P futures lower by about 0.3%. Bit of dollar weakness across the board, although really we have been in that range, 116, 117 for a couple of months now. And that lift into bond prices, yields lower, continuing, although fading some of the earlier move. 10-year yields now barely lower at 4.14. Coming up this hour, Kristen Bitterly of Citi, as stocks fail to maintain post-Fed gains, former Dallas Fed President Robert Kaplan on the growing dissent within the central bank. And Oaktree Capital Management co-chair Howard Marks raising concerns about an AI bubble. We begin this hour with the latest stock rally on pause. Kristen Bitterly of Citi Wealth at Work writing, we could continue to see some volatility around sentiment, but lower policy rates and more accommodative liquidity settings will aid cyclical tailwinds. Kristen joins us now. And Kristen, this seems to be building on exactly what we were talking about with Steve, the idea that the real upside surprise for next year will come from the consumer that's been hanging in there, but is poised to accelerate.
Yeah, that was very interesting what he was saying about the consumer, that could be like the dark horse essentially for next year. But I think you have to take a step back and look at the tailwinds that we're going to have. So the macro tailwinds are certainly there. So when we look at a more accommodative Fed, when we look at the fact that they're injecting more liquidity into the system, that should be a tailwind. We then look at the policy changes and what that means for the consumer. That will also inject additional liquidity. And then I think finally we don't like to talk about this anymore, but the whole tariff thing, at first it was tariff overload, then it was like we're ignoring it. And now I think it's just not as bad as everyone feared, and the direction of travel is actually better than what people had expected. So what does that mean ultimately for the consumer and for corporate earnings is actually net positive.
This points to a really optimistic view for equities. Does it point to an optimistic view for bonds, given that there is an inflationary tilt here? There's a question, can you have your cake and eat it too, with more stimulus on fiscal, more stimulus on monetary, without commensurate inflation picking up?
I think that's the tricky part. So when we look at what, we hear this all the time, that many people are saying that this is the moment now to extend duration. I don't think that's the case. And certainly our team at Citi Wealth is saying, in terms of duration, I think we need to be relatively conservative. So you're not hanging out super short end of the curve. You're hanging out somewhere between 5 to 6 years. But I think anyone who's extending duration, you see that volatility on the 10-year, and it's very hard to make that argument that that's where you're really going to place capital. That being said, I do think on the short end of the curve, this is something that's going to, again, be a tailwind for equities, because as we see that short end come down and you have the $8 trillion of cash on the sidelines, that's going to start to be put to work in the market and look for places to invest.
Are we about to turn the page in this AI story? We're about to start another chapter. I think of Sam Altman calling for this code red at OpenAI. I think of the Oracle results that we got yesterday. Do you sense that the way that we are telling this story or telling ourselves the story of AI is changing as a result of what we've learned here in recent days?
So I think the AI story, and we're going to let's talk bubble, talk a little bit here, but I think the AI story, you have to separate two different things. So one is going to be is there a bubble in terms of valuations in the public markets? And two, the CapEx story. Those are two different things in my mind. So you could say, okay, within public markets, we're priced to perfection, and you need to continuously deliver when it comes to earnings. And some of those companies are funding the CapEx via free cash flow generation. Others, as we've seen, through debt, or maybe not, there's not clarity in terms of how they're funding this CapEx. So when we look at the CapEx, I think then you're saying, okay, we've had about $450 billion this year. It's expected to rise another $100 billion. There's estimates that by 2030, it's going to be $5 trillion. And that capital is going somewhere. It's not just they're spending this blindly. So then you're starting to look at who are the beneficiaries of that capital. And I think when people are talking about the broadening out story, that's exactly what they're talking about.
So we talk so much about all that buffets AI, and I think that's by necessity. We're in an early stage of this, talking about the CapEx and the data centers and the like.
And the comparison to railroads and
all of that, and how radical
fiber.
This reform is going to be. But that gets me to my next point, which is, it does seem like we have to at some point reckon with the changes to productivity that are going to result presumably from this. And I think yesterday at that Fed press conference, you had some that began to kind of creep into the conversation a little bit more. I'm wondering, as you look ahead to 2026, is there going to be a real reckoning, or the necessity for a real reckoning about sort of what this is going to mean in real terms? Not the building of AI, but what it's going to mean for the economy more broadly.
Well, I think those were the two things that Chair Powell said that I think were the most interesting. One is the labor market. Like, are we going to see revisions to those numbers, and we're actually going to see negative numbers? That really stuck with me. And his focus on productivity as a positive. So this is something that's going to drive growth, but what does that mean in terms of the labor market? And I think that's been a conflict that we've been discussing for quite some time, where could you have a situation where you're seeing the stock market continue to grind higher? You're going to see gains in terms of productivity, not just for the pure AI plays, but throughout the rest of the market. But what does that ultimately mean in terms of jobs and job creation? Probably not a lot.
Which is, I guess, the ultimate question with this rotation and the outperformance we're seeing this morning and over the past few weeks of the Russell 2000. Can you get a jobless recovery? Can you get a jobless acceleration in the consumer? How much do you need to see a participation in some of the data that hopefully we'll get at some point surrounding the labor market?
And I think bringing this back to this broadening out story, I think when people are talking about it, they're not talking about the same things. So when we say we're not a buyer of the broadening out story, it's we're not going bottom fishing within the equity market, looking at non-profitable, unprofitable companies, or going Russell 2000. You can play a broadening out with actually profitable companies that are going to manage their expense base, that are going to gain from this productivity. Going down in terms of everything's going to benefit in this market, I think that's a very tricky place to be positioned going into next year.
One thing that you do really well is you work with clients who are facing real existential challenges and changes in their fields. And you came out with this 2026 Hildebrandt Client Advisory Report that looks at the legal industry in particular. Yeah. Can you just talk about some of what you found, but also how it pairs with this idea of some of these changes in productivity, these changes in the structure of work going forward?
So we've been working with law firms now going on 56 years. So Citi covers over 800 law firms, 40,000 attorneys we work with. And this is the 18th year that we've partnered with Hildebrandt in this client advisory piece. And some of the key insights, there's a lot of corollaries to what we're seeing in public markets as well. So you're seeing really strong revenue growth, but what are you also seeing? Modest increases in demand. And so this concept of pricing power, stealing share becomes really important. AI is a must. So you had firms saying AI is not going to disrupt our industry a couple years ago to now this is a fundamental where we need to spend money. I think an interesting thing bringing this to the labor market is what used to be a pyramid type labor force within the legal industry is now becoming a cylinder. Because how can you charge for associate level work when we know Gen AI can do that summarization, when we know, so you're going to see some disruption in terms of how you bill, how you hire. And I think this is going to be something every advisory business is going to need to grapple with. How do you train the next generation of advisors when you acknowledge that, yes, maybe you were losing money on that part of your workforce always, but now it's even more prevalent?
Let's linger on this because I imagine there's a lot of anxiety among 3Ls who are wondering about their job prospects going forward. But it sounds like from what you're saying, we are looking at potentially a radical re-envisioning of what corporate law life is going to be, and what's that going to mean for that specific employment picture?
Absolutely, and I think there's also, I think from an employment standpoint, we need to start getting creative. So if you're saying, okay, the return on that investment, the return on human capital is not going to be what I need it to be, maybe it needs to pivot to something where it's actually more of, like, think of it like a graduate program, like a master's degree, where your compensation, your compensation could change, but maybe you're on the back end of that, you have a commitment to that firm. So I remember when I did my MBA, that's exactly how it worked. Like, you were paid less, but then you had a commitment to that firm in terms of repaying that. I think we're going to start to see similar dynamics because you need to train the next generation. Otherwise, you're not going to be the firm that says, okay, I'm going to train the next generation, and then someone else is going to go and poach this talent once they become, a full-fledged advisor. So this is not something unique to the law industry. We're going to see this in investment banking and other areas as well. And I think it all points to large versus small, if we kind of pull this thread a little bit more, large versus small, what do we think we're going to see? Because of the cost of AI, because of the cost of all of these services that you need, you consume, if you're a smaller firm, that's much harder to do versus a larger firm, which points to M&A consolidation.
Which we have continued to see throughout the year, and we've continued to see the likes of Walmart pull away from some of the smaller retailers. Kristen of Citi, you're going to be sticking with us, I'm very pleased to say. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Nobel Peace Prize winner Maria Corina Machado is planning to return to Venezuela and go back into hiding. Machado made her way to Oslo early this morning, hours after her daughter accepted her prize on her behalf. She declined to comment on her journey, saying it would put her helpers at risk, but saying she would one day be able to tell the story of her experience. Meanwhile, JetBlue opening its first ever airport lounge next week. The new space called Blue House at New York's JFK Airport will span 2 floors, serving primarily premium customers and the airline's credit card members. Our own Lisa will be sitting down with JetBlue CEO Joanna Garrity in the new lounge next Tuesday at 11 a.m. And YouTube TV planning to roll out a major expansion next year. The Alphabet-owned platform expecting to launch over 10 new genre-specific subscription plans in early 2026. This includes a dedicated sports plan featuring networks like ESPN and FS1 with NFL Sunday Ticket as an optional add-on. The company has yet to release a pricing plan for the new subscriptions. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Bundling, unbundling, bundling, unbundling. I feel like
cable all over again.
I mean, exactly, like. Right? Netflix, maybe not. I don't know. Is it YouTube or is it competing with the likes of Warner Brothers? Up next, the morning calls, plus former Dallas Fed President Robert Kaplan on the growing dissent within the central bank. That's next. This is Bloomberg Surveillance.
The Fed is recognizing that right now, where they have monetary policy, they are neither pushing down on the economy in a measurable way, and they're not pushing up on the economy in a measurable way either. They're kind of in a stance where they could go in either direction. That's another way of the Fed underscoring the bar is really high for another cut.
That was Claudia Sahm of New Century Advisors after we did see 3 dissents yesterday, the most going back to 2019 on the FOMC. Good morning. Welcome back. What we are seeing is a little bit of softness on equity futures, down 0.3% because of Oracle, dragging down the post-Fed high that we saw yesterday. Little dollar weakness, 117.15 to going out to the 4th decimal place. And 10-year yields down about 2 basis points, building on the rally from yesterday of 4.13%. Time now for the morning calls. Oracle is the name to focus on. First up, JP Morgan cutting its target on the tech stock to $230, highlighting the weak third quarter guidance. Meanwhile, Bank of America lowering its target to $300, citing an investment curve issue. And finally, BMO cutting its target to $270, calling second quarter revenue lackluster. All of these kind of negative calls explaining why the shares are lower by 13% ahead of the open. Turning to the Federal Reserve, the central bank delivering its 3rd consecutive rate cut and maintaining its outlook for just 1 cut coming next year. Robert Kaplan, the vice chair of Goldman Sachs and former Dallas Fed president, joins us now for more. Rob, thank you so much for being here.
Good to be here.
So the big story really is dissents, and how much is this going to be a fractured Fed going into 2026? You think maybe we're overplaying that?
Maybe, I think so. There's a reason that there was a lot of debate going into the December meeting. They're now at what I would estimate the neutral nominal rate. There's some people on the committee, I might have been one of them, who would have said if inflation's running above target and GDP is going to firm into next year because of tax benefits, et cetera, you want to be a little above neutral. But they've made a decision and that they've gone ahead and cut. I think from here, I don't think you're going to see as many dissents, and here's why. I think there's pretty good consensus that if they're going to move further from here, you either need to see a weakening in labor, which I think is unlikely, or a improvement in inflation. But I think there's pretty good consensus now. There's a lot of debate, and I understand why, on whether they should have cut in December, but that's behind us now. From here, I think you'll see them be pretty conventional And I would guess if there's a dissent here or there, it'll be episodic. I think they got pretty good consensus now.
Even with any new leadership on the Federal Reserve?
Well, so I'm talking between now and May.
Okay, but there's a lot of daylight.
So in May, here will be the change in May. And so then this was what will make it. And I think this Fed is going to be reluctant to anticipate disinflationary improvements. They're going to want to see inflation improvements before they move again. I think in May, you'll see a new Fed chair be more inclined to anticipate improvements in inflation, either due to AI or Chinese manufacturing overcapacity. It depends on who's around the table. I think some members will be less inclined to want to anticipate that, but I think that's the direction of the new Fed, is going to be more inclined to anticipate inflation improvements.
So I was struck by a couple of things yesterday, and I have a more sort of dovish read on the Fed, and I think that was what the market was picking up in the immediate aftermath. Maybe they're incorrect to do so, but a focus on downside surprises to the labor market, indicating job losses of 60,000 to the 40,000 gains that we had been seeing reported. And then this focus on productivity, the idea that you could have your cake and eat it too, with more robust GDP without inflation on the flip side. Why do you think that's not going to necessarily gain the mainframe of the Fed and allow them to cut much more aggressively going into 2026?
So the two things that jumped out at me from the Fed forecast, the summary of economic projections, is the firming in GDP they see going into next year. So that tells you if unemployment is weaker, it's not going to be cyclical. It's going to be a structural issue. I don't think that's the role of the Fed, to deal with structural. People looking for jobs don't want the jobs that are open. I think they should be focused more on cyclical. They're projecting a firming. The other thing that struck me is their inflation forecast is pretty benign. They show an improvement down to the mid-2s. So if that's the case, that's how they get room for another cut. Because if the neutral rate right now is 3.5, 3 3/4, if inflation improved another 25 basis points, I think they'll think neutral's 3 1/4, 3 1/2. It all makes sense to me. I would call this now a more balanced Fed from here to May, not so dovish, more balanced. I think you need to see movement either again in jobs or inflation for them to move. In May, that's where you'll see the tilt again, and you'll see new debates about whether that tilt toward anticipated inflation, whether that's appropriate.
I want to ask you about inflation in the context of tariffs, and the Fed chair yesterday defended that 2%-ish target once again when he was asked about it by a reporter. But he also had this admission which stood out to me, which was if you took tariffs out of the picture, you're kind of in the low 2s. How are you thinking about the role that tariffs are having in an inflationary sense right now? And what did you make of him saying that? I mean, not really equivocating when he said that to reporters yesterday.
So I'll give you a slightly different tilt.
Okay.
Goods up to 2025 have been disinflating. Goods have not been the inflation problem in the United States. Services have been the inflation problem. They're running in the mid-3s. They're still running in the mid-3s. Tariffs have temporarily interrupted the goods disinflation. So I agree, goods won't be the problem over the horizon, but services are still sicky. We're very tight on the labor force. And so I think what they're going to be looking for, and what I'll look for, is there improvement in services, or as services stay sticky in the mid-3s? And I think the jury's out on that, particularly in a firming economy with a very tight labor force.
Something Jay Powell didn't bite at yesterday were questions about Fed independence and personnel. Took us to May. Let me take us a little bit beyond there. There is this kind of popular misapprehension about what a new Fed chair is going to be able to do. And I don't want to intimate that the president shares that misapprehension about it, but he's certainly fueling this notion that he can put somebody in that job and he or she would be able to take the Fed in a new direction. So with your confidence in the level of unanimity, so much as there is among policymakers now, and that might continue, what does a Fed chair have to have or be able to do to herd the cats, keep them in line going forward in May? And as he's talking to all these folks, the Kevins and Mickey, all these folks, what should he be asking? What should he be trying to identify about that person's capacity to play that very important role in running the FOMC?
So I think there are likely to be 3 changes post-May. And I would say, number one, I don't think the goal of the new Fed chair should be to minimize dissents. It should be to have a good process, a good debate, to be able to explain decisions. And if there's more dissents, it's okay, to me. But there are three tilts you're going to see. One, I mentioned earlier, they're going to be more likely, new Fed chair is going to be more likely, I would guess, to anticipate inflation improvements. Not everybody around the table is going to love that, but I would guess he or she is going to be able to get 7 votes. So in other words, they'll be able to make the decision. Second, the Fed balance sheet. Is the new Fed chair going to be more inclined to want to extend maturities in the composition of the Fed balance sheet, go from a reverse twist, less short, a little more long, and I would guess in the years ahead, the bar for QE may be a little lower. That's the second. And then the third thing, regulatory reform is well underway. Mickey Bowman is driving that. I think a new Fed chair will be an enthusiastic partner that might help speed that along even further. I think those will be the three changes you're likely to see.
Which, just bleeding over to your current role, how much do you see right now the risks building, not necessarily in 2026, but 2027, 2028, when you have financial institutions that are encouraged to take risk? You have elevated asset prices as a result of an easy Fed policy, maybe not now, but certainly down the line, which is what's expected. Do you see that as becoming increasingly a risk to watch as people talk about bubbles?
Well, so I personally don't think we're in a bubble right now. And I think even on the AI front, the AI CapEx is a percentage of GDP based on, right now when we say AI bubble right now, we're talking about infrastructure. I think if you look at the infrastructure spend, I think based on a percentage of GDP, based on the cash flow of the companies doing it, it's not, someday it will get overdone. It's not overdone yet. And remember, the big opportunity in AI is not the infrastructure for the economy. It's the adoption. And I would argue we're in the early innings on the adoption. The adoption that should help drive, we hope, a 0.5 percentage point jump in productivity growth as part of GDP and will drive margin improvement. I would argue we're in the first couple of 3 innings of it. That's going to unfold over the next 2 or 3 years. And we're all going to learn a lot about what use cases work and which ones don't. And so I think that's a great opportunity. I think the next Fed chair is going to have to, there'll be the zeal to anticipate improvements, but I think he or she is going to have to be it's going to have to be balanced and apolitical because, yes, the markets are watching, global markets are watching, and you also don't want to run up in the long end of the Treasury curve.
Yeah, which we haven't seen, actually, since this particular meeting. Robert Kaplan, wonderful to see you. Let's do this again. Robert Kaplan, former Dallas Fed president. Coming up, the latest jobless report set to cross. Blerina Uruci of T.Rowe Price joins us, as well as, of course, Kristen Bitterly. This is Bloomberg Surveillance. If you want outperformance, you can see it in the Russell 2000. Futures higher now, even as the rest of the equity indices sag. You got 0.3% decline in S&P futures. The Nasdaq lower by 0.5%. Russell 2000 eking out gains, but just. Meanwhile, when you take a look at the bond space, 2s, 10s, and 30s, you do see that bid continuing to strengthen after yesterday's rally. Even at the front end, yes, that has been the biggest rally point, 3.53% rounded up. The 10-year also getting a bid. Jobless claims data just crossing. Bloomberg's Michael McKee has the numbers. Mike?
Well, not just crossing yet. We're a little bit delayed here, but that sometimes happens when everybody clicks on the numbers at once. We do have the trade balance for the month of September in now, negative $52.8 billion. That's a little down from the 59.6 that was the initial report. Now, this includes services as well. Exports up 3%, imports up only 0.6%. No surprises there, given the tariff situation. Initial jobless claims are now in 236,000 last week after a revised 192,000 the week before. That 192, very low, but that was the week of Thanksgiving, so there wasn't a whole lot of people going out to file their initial claims. 236 is much more in the range that we have been in on. Initial claims on a continuing basis, 1,838,000. That is down significantly from 1,937,000 the week week prior. So it does suggest that at this point, what we're seeing is the labor market in stasis. Not a lot of change, not a lot of people getting laid off. We know that hiring's been weak as well. So the Fed's whole argument yesterday was the labor market needs propping up, but no sign of it right now.
Michael McKee, thank you so much. Taking a look at what the response is in markets, it is further dollar weakening. It is an ongoing bleed lower in terms of the equity indices. Right now, we're seeing Russell 2000 futures lower after being higher earlier. You're seeing that NASDAQ decline continue. In the bond space, you are seeing some justification potentially for that dovish tilt to the Fed, given the fact that this is a higher jobless claims number than previously expected. And you're seeing that bid continue throughout the yield curve. Just really interesting. And Kristen, bitterly, I'd love your thoughts on this. This is confusing data. We're looking right now at data where jobless claims are coming in. We saw the biggest increase going back to March 2020 in this latest read because of what we just saw in the previous week. How do you understand this?
So I think this is exactly what Chair Powell was talking about yesterday in terms of looking for weakness within the labor market. And I think the Fed is definitely leaning more towards let's make sure that we're protecting the labor market. Inflation, we're going to watch that closely. But the bigger concern is really making sure that we have a grasp on what is happening within the labor market. I think this is largely in line. Yes, it's elevated, largely in line. As you know, one of the things that we're watching very closely is the continuing claims. And so this is something that, if you are someone who did lose your job, how hard is it to find a new job? And how is that going to actually then flow through into areas like consumption? And so we just heard that, yes, there are some structural elements when we think through what does this mean from an AI perspective and who are the winners and losers in the employment backdrop. But I think this is something that right now, there's no cause for concern. It's like a frozen market. But if you are someone who's out of that market, it's a really, really challenging place to be in.
Yeah, and it's challenging to get a read on this. Blerina Uruci of T.Rowe Price joining us now. And Blerina, how do you get a clear read on the labor market when the data's messy, the trends are messy, the structural changes are unclear?
So I think the story of the U.S. labor market throughout this year has been one of low hiring and low firing. And when you look at the initial jobless claims data today, I think they reinforce this message. We're seeing, yes, of course, a little bit of an increase in initial claims. But if you take it within the noise of the last couple of weeks, I think you can smooth out broadly stable initial claims. So we're not getting big flows of unemployed workers in the labor market. But you look at the continuing claims trend, that has been moving higher steadily throughout the year. And that's telling you that those workers that came out of the labor market are finding it harder to find a job because the number of vacancies in the economy and the hiring demand from firms has slowed down significantly. So it is this kind of labor market. The message for me is that the labor market is not overheated. It's definitely not as tight as it was in 22 and 23, but it's not rolling over either. So this concern that the Fed has about the weakness in the labor market, I think it's a bit overdone at the moment. And certainly I thought Powell's comments yesterday were extremely dovish with regards to the pace of the employment growth in the economy and this idea that we need to adjust monthly payroll data down by 60K per month. And that's the true underlying trend rather than what the BLS is publishing. I think this is a bit of a dovish interpretation of what's happening in the labor market.
Let's stick with that if we can. Far from me to suggest you do some psychoanalysis here of the chairman, what he was thinking in that, and as he thinks about this particular issue. But I'm curious, as we tease this out, why you think he's coming to that conclusion now, what he's buffeting that on. And then I guess I'd love a gut check from you just on the density of the fog that policymakers and economists are operating in right now. Yes, we have these figures, but we're waiting for so many other pieces of and reports of data that have been missing because of the government shutdown. How much are policymakers fumbling as a result of that right now?
Okay, so let's start first with this idea that we should revise down the payroll numbers or not take them at face value when they're being published by the BLS. Where is that coming from? Where when we look at the benchmark revisions for U.S. employment data over the last 2-3 years, it is true that those revisions have been to the downside. And so I think Fed staff has come to the conclusion that there is a downward bias in the BLS estimates. And I think we, as forecasters and economists, broadly agree with that conclusion. I think the magnitude maybe is up for debate. It might be actually smaller than 60K. So I think this is where his assertion is coming from. And perhaps staff estimates at the Fed are a little bit more concerned or more negative on the labor market than perhaps the private sector forecasters. And then how much fog is in the data right now and how do we navigate that? A ton of it. Of course, not only do we have these mixed messages from the economy, we also have delays in the publication of the data. But I think it's important to look at the entirety of it. If we indeed had a labor market where the US economy has had consecutive negative payroll growth numbers, would we actually see GDP and consumer spending remain in positive territory? Would firms invest as much in capex as they've done over the course of the first half of the year? And would the unemployment rate only increase a little bit? I think the answer to all those questions would be no. So looking at the entirety of the economy, it's softer than it's been in the last few years, but it's definitely not weak. And what we've done on top of this is that we've eased financial conditions. We've cut interest rates, balance sheets of consumers and wealth is looking better. And then in Q1, we'll get some tax credits both to the corporate sector and to the household sector. So all those things, I think, should support growth in the labor market in 2026.
Blerina Uruci of T.Rowe Price, thank you so much. And Kristen, just to finish on this idea of heading into 2026, does yesterday what you heard from the Fed make you more bullish and frankly want to take more risk?
I think it makes me more bullish in terms of the prospects for the first half of 2026. So the tailwinds that we mentioned of yes, we got the cut. That was almost like relief, just to make sure that was a known. But then when we look through the other tailwinds that have been discussed all morning on this program in terms of the stimulus that's going to come into the economy, the benefit ultimately to the consumer, the continued capex, and how that's going to drive a broadening out. So I do think there's an argument that you're going to see some tailwinds. I think we do have to keep a very close eye because this data is foggy. So this data when it comes to employment is foggy. We've also seen what happens with Oracle in terms of the market saying if we don't have clarity on how you're financing, there's going to be a delineation. Just like we talk about a K-shaped economy, I think we're going to see K-shapes within sectors as well. I don't think this is something where it's going to be everything is going to go up simultaneously. We're going to see some volatility. And just like we have even with financials this year, you've seen some big money center banks do very, very well, but the regionals haven't performed as well. So I think that's going to be the challenge going into 2026.
Kristen Bitterly of Citi Wealth, you are wonderful. Thank you so much for being here. Look forward to the next time that you're on. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping that data we just got, U.S. jobless claims ticked up last week, rising to 236,000, which came in above expectations of 220,000. That's an increase of 44,000 from the week prior and marks the biggest jump since 2020. Better news for continuing claims, which came in around 100,000 less than expectations at 1.84 million. Meanwhile, the United Nations is no longer providing paper towels in restrooms at its headquarters. The move is a result of the UN's funding woes and is expected to save the organization $100,000 per year. The U.S. typically funds 22% of the UN's regular budget, but has yet to pay the more than $800 million it owes for this year, as well as some arrears for previous years. And in sports, MLB All-Star Pete Alonso is heading to Baltimore after signing a 5-year, $155 million contract with the Orioles. The 31-year-old slugger has spent his entire career with the New York Mets, where he became the franchise's all-time home run leader last season. It's the second day in a row the Mets lost a star player following pitcher Edwin Diaz's departure to the Dodgers. Sorry, Lisa.
Yeah.
To Bloomberg Brief.
No kidding. I feel the pain in my household. It's roiled. Yahira, thank you so much. David Gura, you will be back with us tomorrow.
Yes,
thank you so much for everything this morning. Right now, coming up, we've got Oaktree Capital Management co-chair Howard Marks raising concerns about an AI bubble after a memo that he wrote. I recommend everybody read it. A really fascinating take on the moment we're in. This is Bloomberg Surveillance. Seeing a market gut check some of the enthusiasm post-Fed meeting yesterday after Oracle came out, throwing some cold water on some of the risk appetite, down 0.4% on S&P futures. The bid into bonds actually gaining as the morning grows older after jobless claims came in just slightly elevated, 10-year yields at 4.13%. Turning to the economy, Fed Chair Jay Powell saying AI may be at least partially responsible for the cooling labor market, but the future remains uncertain. Howard Marks, co-founder and co-chairman of Oaktree Capital Market, issuing a warning in his latest memo. I find the resulting outlook for employment terrifying. I am enormously concerned about what will happen to the people whose jobs AI renders unnecessary or who can't find jobs because of it. At this moment of transformation, Howard joins us now after writing a memo that I really recommend everybody read. It really was one of the absolute best that you've ever written. Thank you for being here with us.
So I can stop now.
Oh, no, please don't. I want to keep reading your memos. I want to start with this idea of different types of bubbles. And you talk about there are productive bubbles and unproductive bubbles. What's the difference, and how does that make it either something you want to invest in or not?
Well, I think that the unproductive bubbles I would describe as financial fads. Portfolio insurance was one, subprime mortgages was another. Financial activities that become fashionable, zoom into popularity, get overhyped, and then recede. But then there are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, et cetera. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed and goes to excess and end up destroying a lot of capital, but leave society greatly changed. And I'm sure that AI is in the latter category in terms of effect on society. And the question is, will the implementation prove to have been excessive in scope and in the way it's financed?
Just because something is excessive doesn't mean that you can't invest in it.
No, but when investors hate everything and won't touch it with the 10-foot pole, chances are it's going to be on sale because nobody has pushed up the price. In fact, their disinterest has pushed down the price. But when everybody likes something, is excited about something, chances are it may be overhyped and overpriced. So you just have to be careful.
So that's where we are right now. You said you can invest and you can participate, but you just have to be careful. What does being careful look like? Does it mean focusing more on debt versus equities, more on equities versus debt, more on small companies versus big ones? What does that look like?
Well, what I say in the memo is that it's okay to lend for activities, even if they're uncertain, but not if the outcomes are purely conjectural. I mean, in order to be a smart lender, you have to have good visibility on the extent to which the thing is likely to repay interest and principal. If it's just purely conjectural, it's not. You shouldn't be a lender. And in fact, I think the memo says that where that's the case, you should actually, if you want to participate, you should be in the equity, so at least you get the upside. The lender has no upside. You make a 9% loan, all you're going to get is 9%, no matter how well the thing does. You certainly shouldn't do that in activities that have a high probability of not paying off at all, because then you have unlimited downside and limited upside. That's absolutely the wrong combination.
So you think right now, in some circumstances, the equity might actually be a better option than the debt because of that potential upside?
Yes, exactly, because the point is that if you go into some startup which has let's say a small possibility of a raging success, you wouldn't lend to it because you have a high probability of losing all your money and no probability of participating in the success. That's a bad trade.
So you always talk about this risk-reward pendulum, the risk and fear, the sort of fear and greed pendulum right now. And yesterday we saw Oracle come out and talk about having to borrow more money, having to spend more, and people are selling off the shares. Does this make you feel good? Does this make you feel like there actually is some discretion?
Well, yeah. Well, I think that I think that it's Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. So when other people are acting imprudently and mindlessly and carefree, we should be worried. When other people are showing appropriate concern, that's a positive sign that the market is applying some discipline. Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in 2006, for example. So if people are reacting harshly to aggressive, possibly risk indicating activities, yes, that's a healthy sign. And this market seems healthier than the 2000 market, to me.
How concerned are you that we get a Federal Reserve that's more accommodative for a variety of reasons that leads to even more risk-taking? This idea that not only did the Fed cut rates, indicated more rate cuts, but also is adding to its balance sheet in a way that could potentially prop up demand.
Well, I was thinking about this when I was waiting to see you today. Most of the people listening to this program, including me and you, are interested in the free markets. And we think free markets should set the prices of things. And the Fed manipulations are a form of price controls. They control the price of money. And if the Fed puts money artificially cheap, then it induces behavior like risk-taking. It forces people into riskier activities because the returns on safe activities are so low. It tends to reinforce the view that there's a Fed put, that if there's a problem, the Fed will solve it, and that contributes to risky behavior. These are all bad things. And, I believe that the Fed should be passive most of the time and only come to the rescue if the market is, if the economy is seriously overheated and tending towards hyperinflation, or seriously underactive and not creating jobs. I don't think that's the case right now. I don't think there's and you can see in the divided open market committee that there's a difference of opinion. So I don't think that action on the part of the Fed is compelling right now. And, there are people who think that rates should be a lot lower than they are today. I just don't see the merit in that.
Right now, going forward, I remember back in 2015, 2016, 2017, when rates were incredibly low, you were saying people just need to lower their expectations for returns.
Right.
Because ultimately, you have to look at the risk-free rate, and you don't want to reach too much at a time where people are greedy.
Right.
Where are we right now in terms of what types of returns people ought to expect based on the current income rates?
Well, the lower base interest rates are, everything scales off that. So, the Fed funds rate at 3.5 is below history. These are not high rates. They're only high relative to the last 15 years. But this is a low rate. So everything scales off that. Most things will give moderate returns. In the debt area, I think prospective returns are moderate, okay. Not lush, but not inadequate. The trouble is that the S&P, based on its PE ratio relative to history, appears to be priced to provide a very low prospective return. Historically, if you bought at this PE ratio, your return over the next 10 years averaged in the very low single digits. So I think we're in a moderate return scenario. The problem is that how do you get a high return in a moderate return scenario? And most people's resort is to take a lot more risk. And that's something I don't like to do, other than when it's compelling.
You had a personal note, an addendum at the end, and we led off with that idea of what artificial intelligence and machine learning will do to the labor market. It's something clearly on the Fed's mind, clearly on investors' mind. You're talking about concerns that there is going to be cannibalization from human jobs. How do you see this playing out? How are you kind of grappling with this when you look at investments, when you look at fiscal deficit, when you look at the backdrop for the financial system?
Well, look, Lisa, here I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. And, I've gotten some very nice response from people I respect to the memo. And one of them said he thinks we've seen this in response to the internet over the last 25 years. But it has not raised unemployment because the internet eliminated white-collar jobs that were replaced by blue-collar jobs, like, people who pick stuff in warehouses and send it out in e-commerce. So job count is not down, but job quality is down. And I think that this is very worrisome. And as I said in the addendum, when we lost jobs to automation and offshoring, I think that coincided with the opiate epidemic, and not only in amount, but also in location. And I think it's a natural consequence of people sitting around all day. And even if we can find a way to replace their income, I worry about purposelessness. And, we get so much from our jobs other than a paycheck. And you can't replace that stuff. So I worry for society.
Howard Marks, you are absolutely one of the best. My favorite to talk to. Howard Marks of Oaktree Capital Management.
It's great to
Thank
be
you
here.
so much for being with us here this morning. Coming up tomorrow, Peter Scheer of Academy Securities, Priya Misra of JP Morgan, Liz Ann Saunders of Charles Schwab, and Daryl Cronk of Wells Fargo. This was Bloomberg Surveillance. Good morning.